material. And so the question is going to be, the question is going to be whether it becomes, hi, you're watching this, it's because you're not here.
Or you forgot something.
Or you say you're late, but you're, anyway. So obviously and I'll explain as we go through all the areas why I kind of tried to fit some of these things out. I said last summer when we taught this class the first time, I think it was overly ambitious trying to include material, so I'm going to try to take some of it out. Hopefully we neither lose too much and water it down to the point that you're going to say, what's the purpose of this? So hopefully that doesn't happen, and hopefully there's enough relevance that you say, hey, it's good. So anyway, so we're going to go through. As I said, in order to understand financial statements, part of what we need to gather is understand how they're accumulated. And so we're not going to do like debits and credits today as much as we're going to do more conceptual, how certain transactions are accounted for. Okay. Good afternoon. You're close enough. You're interrupting me, so I probably should take points out. But you're close enough, both of you, to not be marked late. So close enough. Close enough. Okay. All right. So we're going to do that. We're going to do some current events. We're going to go over the case study. And then we're going to do some things that will help prepare you for the next case study. I hope we'll do a little quiz afterwards. Yeah? Sound like fun 4.5 hours, something like that? Yeah? Okay. So, any questions from last week? James?
I have a question on the Wall Street Journal assessments. Are there specific articles we need to read? Because several of the questions started according to the article. And it's like a week's worth of reading, and then when they get to the assessment, it's like very specific questions that we're expected to render in 10 minutes. Yeah. It's kind of
so I mean, the problem with that. So the purpose. Let me kind of come back to my objective in using these things. I started using this about 3 or 4 years ago, and the reason I did that is honestly, I really wanted to force the students to get into the habit of reading the financial press every day. So there is a feature that I have as the instructor in the program to actually send you the articles and the link and give you an hour to do so I can make it really dumb. I could say, here's the 5 articles where the questions are going to come from. You have an hour, read it, and then answer the question. But then you're not going to be doing the reading, which is the objective here is to get into a habit of reading the financial press every day. And trying to figure out what's relevant and what's not relevant. I was explaining to Armando at the beginning, part of this is a cumulative process, James. I mean, you can't expect to pick up the newspaper today and know everything that's happening in the world. But I can assure you, if you go through a habit of reading every day, right? So if I were to ask you, who are the 4 contenders to replace Theresa May as a Prime Minister in the UK, if you don't read the newspapers, you probably don't know. You may not even know she resigned. You may not even know that she's the Prime Minister of the UK, right? Yes. But if you read the newspaper every day, you might think that, well, maybe Boris Johnson or Jeremy Hunt, right? Might be in line, to succeed. And so it's the same thing with finance, right? And so to answer your question, you got to read all of the paper. Now, what's my advice to you? My advice is that you cut out the stuff that really doesn't have financial relevance. So every day there's a section, or well, I read it online. I suspect on paper it's still a section, but there's still an area of the paper that's got fluff, life and art. Like stuff about movies and actors and recipes, and there's a whole section on mansions, like house sales, and I wouldn't read it. Clothes and shoes. I wouldn't read any of that junk. Not for the quizzes. You're never going to get. Now, in a way, it's kind of like any kind of test in an academic setting. There's always this huge body of knowledge, and you don't test the whole body of knowledge. You test certain specifics in it, right?
Yes.
And so, it's going to be hit or miss. You might not. I mean, I was telling Armando, I really didn't have a chance. It's been a pretty hectic week for me, and I would say that I read the paper all week. But I did go through all the headlines on the journal this week, probably every day. I may not have looked at it one day, And I took the quiz yesterday. It was like, okay, I got a 70. I mean, did I feel good? I didn't feel great, but I didn't feel bad because I felt as if I was close enough to what was happening. And frankly, some of it, I didn't know some of the questions at all. But there's enough sense from having read cumulatively that you can, sort of triangulate. And James, some of that is having familiarity with, you go see a client and they start talking to you about something, and if you don't know, how do you feel? So the purpose of this is, look, I can give you hundreds. I almost give you hundreds. You get 70 for just showing up here. I mean, I can give you hundreds on everything, right? Just, But the purpose is to build habits. And the habit is to get used to reading the paper, not, oh, these are the 5 articles. My experience has also been, honestly, being candid. When I used to use textbooks in the class, there would always be, historically, in the 4th class, I would do a pop quiz at the beginning of the class. And do you know what the results of that pop quiz usually were? And it was always on the reading material. It was terrible. And I would ask really difficult questions like, broadly speaking, what was the subject matter that we were meant to read? Ask me one question about the reading material that you didn't understand. And people would kind of say, yeah. So, my experience is if you read because I have to read these 5 for this, you're not going to read the rest of the paper. And the purpose of this is to develop habits, at least from my perspective, is to develop good habits, okay? As opposed to, oh, here you get 1 point. I mean, they're worth 1.43 points each, okay? So if you kind of read it and you get a 70, you're getting your way up to that B plus A area, So maybe not satisfied, I don't know.
No, it's just, some of the questions start off with, according to the article.
Yeah.
And kind of, which article are you speaking of?
Well, but you can figure out, but you can figure out, right? What you don't have time
to figure out.
What you don't have time, I mean, that's the assessment. I don't want to get into the whole, theory behind it, but this is kind of the assessment a little bit of exams and quizzes, right? I like to do these end of class exams. You don't have to remember what happened the last week. You just got to focus on what's happening now. For a couple of terms, I was playing around with these, like with the GoToMeeting tools, and I would record some things, and then, people weren't coming, recording stuff, and so I started doing the quizzes not after the class, but you had till Monday to do it on Blackboard. We used to use Blackboard. I guess we use Canvas now. And I saw a huge change in the results because all of a sudden, in 15 minutes, people had their notes next to them, and they were just going to the notes. And you can see from the, from the answers that it wasn't like people had really learned or tried to focus on. They were just saying, okay, I know that if I take some notes, I don't have to really think about what's going on. And the purpose is to reinforce knowledge. I think I keep going back to, it's about learning. It's not about getting 100. Yeah, we want to get 100. We all want to feel good. We all want to, but anyway, so. Any other questions on the material? So a word of advice. I just want to, I think I had 2 questions prior to the submissions of the case study this week. Now, I don't want to say that the case study this week was that difficult, but I sent the things out on Saturday night, and it's radio silence till sometime Monday. Okay. And then I don't get questions. And so, my thing is use me. That's why you pay for the program. Hey, professor, how do you want us to focus this? How do you want to, and I'll go through some of the submissions later on and provide some input, but, learning is kind of an iterative process, right? You ask, you get an answer, you ask, and as we get into some other, you'll see that some of the answers I give might be a little bit vague. They might not be the specific direct answer you're looking for, but they hopefully point you to a place so that your brains are sort of, anyway, so let's go through some, let's see if I have anything else. Oh, yeah, before we even start, where's the 10-year Treasury yield today?
230.
I got a 230, I got a 3.
239.
239. Adriana, did you have no opinion? No, you don't know.
2326.
Did you pull your phone out? If you hadn't pulled your phone out, would you know? A tree fell in the forest, and nobody heard it. And so if you're sitting with a client and they're talking about, development, and you're trying in your mind just to formulate, some potential cost of debt or capital in your mind, what do you say? Excuse me, I'm not trying to put you on the spot, but I'm going to pull my phone out and say, you don't need to know that it's 2.236 or 2.326 or 39, depending on, because I saw two different things yesterday and then today, but that it's somewhere between 2 and 3, 2.3 and 2.4. You should know, and you should know how is that in relation to where it was last week. Is it higher or lower? It's actually a little bit lower. And what happened Thursday?
Okay.
I mean, it is a benchmark for our industry. I'm not trying to pick on you, Brandon. It's a benchmark for our industry. And if we don't read the tea leaves, right, then we don't know where things are going. I saw one of my former football players yesterday, and he was asking about real estate and this and that. And I said, look, I could be wrong, but in my mind, as I read the tea leaves, it's a time to be a seller, not a time to be a buyer. Now, I reached that conclusion based upon what I read, what I have in my gut, right? I may be wrong, and you may have a different conclusion, but you can only reach that conclusion through information. Knowledge is power. The more knowledge that you have, the better off you are. So, interest rates have continued to creep down. It actually went below 230. The 10-year Treasury is at the lowest that it's been in 19 months. And about 24 months ago, it was at a historic low. So we're almost at negative interest rates in this country, real rates of interest, right? Do you know what real interest rate is as opposed to, I always like to throw these things out. Do we know what the difference between nominal and real interest rate is? They don't equal each other. Do we know the difference?
One including inflation.
It's not prime. So prime is a term that's not used that much anymore, but prime would be the rate at which banks would loan to their best customers. So you still see that quoted every now and then, but that's not, now people tend to quote interest rates at some premium to a particular index, okay? And the index that's for now used the most is LIBOR, okay? And do we know what LIBOR is?
I'm going to do it at the
London
Interbank? Or
Interbank
lending.
National Bank?
Lending.
No, it's London.
London
What's
Interbank lending.
LIBOR? I always ask this. What's HIBOR?
London Interbank lending.
No, HIBOR is Hialeah Interbank Offered Rate. So, not in Hialeah, we're in London. LIBOR is the London Interbank Offered Rate. What's an interbank offered rate? What does that imply?
That's the way the bank lend to each other.
So that's the rate at which banks loan to one another. In this country, so LIBOR, there's a reason, and I'm not going to get into all the reasons. LIBOR, why is the London Interbank Offered Rate so important? And the reason is, London is, whether we like Brexit or not, whether we think it's happening, London is really the financial capital of the world, at least the money center capital of the world. New York, CNBC comes out, oh, from the financial capital of the world. New York may very well be, but the reality is London has a bunch of different unique advantages. In addition to having been, the original sort of explorer and conqueror in the world, right? And being a people that are very mobile, right? And being all over the world, and expats all over the world. So as a result of that, banks there were always very strong. They happen to geographically be located in a place where, when Tokyo closes, London opens, and when San Francisco opens is when London closes. So London happens to sort of reach the broad spectrum of the world. Okay, now there's a whole bunch of other reasons. Banks. So London is a big money center bank. And so the rate at which banks loan, Oz, hello, how are you? Loan to one another is very important. In this country, banks loan to each other with what rate? What rate do banks loan to one another? It's a rate, it's a concept that's thrown around quite a bit in this country. So you hear lately the Fed tries to target a particular interest rate. What rate is that?
prime rate you were just referencing?
No, not the prime rate. So there's a couple of rates that are relevant as it relates to the Fed. The first and most important one, which people don't talk about, is called the discount.
Discount rate.
Okay? And what's the discount rate? Now, I'm not talking about discount rate as it relates to a financial projection. What is a discount rate as it relates to interest rates? So the discount rate is the rate at which the Fed loans money to its member banks. So if you're a bank and you need to borrow money, you can, number one, go to the Fed, you go to the discount window, and you borrow money. Okay? So I would sort of propose that that really is the base interest rate in this country, but I don't want to get into that. That's for another class, okay? But the discount rate is the rate at which the Fed loans money to its member banks. Now, why would a bank need to borrow money? Well, the Fed has reserve requirements. You know, they may have some sort of matching, liquidity matching issues, and so that's why they need to borrow. But if a bank goes to borrow money at the discount window, that's kind of like walking around with like, what do people walk around like a leper or an adulterer, like an A or an L or whatever? That's a bad sign. Banks find out if other banks go to the discount window to borrow money. So banks try not to go to the discount window because it's a sign of financial distress. So what banks tend to do is they tend to borrow from one another, and there's something called the Fed funds rate. Okay, and in this country, the Fed funds rate is like LIBOR. It's the rate at which banks loan to one another. Okay, and banks tend to have very high credit quality, and so it tends to be a very low rate, very low risk. Okay, so in this country, we loan to, banks loan to one another with a Fed funds rate. Now, going back to where we were going, and I'm expanding on this. Typically, we see loans quoted as LIBOR as a base plus some sort of premium, okay? And that premium is going to include a lot of stuff in it. Again, that's for a different class, but it's going to, probably single biggest component is going to be some sort of default or credit risk associated with that. Okay, so, I mean, I would tell you, maybe a construction loan to a very, credit-worthy, high substance, guarantor is maybe today's going to be at LIBOR, plus 250 or something like that. Maybe a little bit less, maybe a little bit more, something in that range. Okay, so that's what LIBOR is, and that's a premium which you see it. Now, what's the difference between nominal and real rate of interest? Nominal is what's quoted, right? So if you go to the bank and you borrow money at 5%, you're going to pay 5%. But theoretically, that's comprised of two different components, and that's going to be a real rate of interest plus some sort of inflation, okay? All right? And the real formula is like 1 plus real multiplied by 1 plus inflation equals 1 minus n, okay? But it doesn't matter. Really, the concept is the real rate of interest plus inflation. So the theory is if inflation is 3%, right? Let's work backwards algebraically. If today the rate of interest is 2.3% and inflation is 3, what's the real rate of interest being earned right now? It's negative. It's negative, right? Okay, so and what is the real rate of interest? Do we know empirically? Do we have what should the real rate of interest be? I mean, are interest rates at 2.3% low or high historically? And why is it's low? And where should they be? Because we need to know where we are in cycles, right? So if we're going to borrow or buy or sell, we need to understand where rates are going to go. One of the questions in the case study was, is the company's debt structured more with fixed or variable interest? The next part was, is that good or bad? So that's going to depend on your perspective of where interest rates are going to go. So where should historical interest rates be? What is the historical real rate of interest? Any idea? No?
It's what the Fed sets it at, right?
No, so the Fed targets, I don't want to get into this because the Fed works through a variety of different ways, and they do these open market operations in which they buy and sell treasuries to influence
funds.
The Fed funds market, okay, so they're targeting, what they're targeting as a baseline is the rate at which banks loan to one another, and then there's a sort of,
Spread.
I just don't have the time to do this in this class, based on credit risk, a reason why different rates, okay, are different, right, or higher from that. But this is kind of a baseline interest rate that, you know, in this country, the Fed uses, but, so, historically, if we go back in history, if we go back 200 years, if we go back 300 years, right, what should the real rate of interest be? I mean, we can definitely calculate what inflation is, and we can definitely calculate what the nominal rate is, so we can kind of infer what the real rate of interest should be, right? We can kind of back into that. So, do you want to know? Or I can move on if you don't want to know. If you want to know, I can tell you.
I want to know.
It's about 3%.
3-4%.
Okay, it's about 3%. Okay? And so, you know, in this country, if long-term inflation has been at like 2.5%, if in fact what I'm telling you is true, and the real rate of interest is somewhere around 3%, in a normalized setting, you know, nominal interest rate should be somewhere between 5 and 6%. And those of us who are older, when we were growing up, you know, you go to the bank and you put money in a passbook savings account, you got 3%, and then what did the bank do? They would issue mortgages, and how much would the mortgages be priced at?
6-7%.
6%, you know, 7, you know, in that general range, okay? And so, probably somewhere around 5 or 6 in non-hyperinflationary environments, right? It's 1980, inflation's running at 18%. What were nominal interest rates at that point? 20%? Okay, so theories, but they help us explain and understand where things are going. So in inflationary environments, if we're expecting inflationary environments, we're going to see interest rates go way up, right? So, you know, in that context, if you're a real estate investor, you probably want to fix rates for a very long period of time, right? Because you're going to have, hopefully, rents that escalate with inflation, right? Then you're going to have costs that are going to be fixed, right? And that's like a good place to be. As opposed to being in an environment where rents are coming down, right? And interest payments are going up, right? You don't want to be there. You want to be on the other side of that.
So
So,
what you're saying is that that rate, the nominal rate, is directly affected by
inflation.
inflation. But I always thought that the rate was set by the Feds to control inflation. That they use it as one of its instruments to.
So the Fed has two mandates, which are kind of, look, and I'm not an economist, okay? So, I mean, you're taking me to areas that are a little bit beyond. The Fed has a dual mandate, which is lower prices, so price, inflation, and full employment. And sort of from an economic perspective, full employment brings on inflation because there's pressure on wages, okay? So they're kind of polar opposites, okay? So in today's environment in which the president tweets every day and every member of Congress is on some television station saying what they want, and you know everybody's got a blog saying whatever, the Fed's under a lot of pressure to do a lot of different things. And at the end of the day, it's a bank of banks. It's really what it is. You know, the Fed's there, I would tell you pragmatically, for no other reason than to facilitate a payment process mechanism, right? Because banks need a bank to be the clearinghouse, okay? And that's kind of like the baseline fundamental reason why the Fed exists. Now, there's this macroeconomic overlay that you put on top of it, or that the federal charter is put on top of it, right? But so they're trying to control inflation and full employment, and they're doing that by impacting interest rates, right? Trying to impact interest rates. Now, nominal rates, right? So, you know, the question becomes, which one of these can they really impact? Can they really impact inflation, right? You know, I would tell you that that's probably fixed. So what they're trying to do is somehow control that, but it's kind of difficult to do that, right? Now, yeah, you can print money or not print money, right? I mean, there's a lot of different things you could do, but yes, Jack.
So, based on some of these indicators, you said that you want to be a seller. I mean, are we talking about long time or?
I'm sorry?
Based on some of these indicators that you just talked about, you said at the moment someone want to be a seller right now.
Well, I mean, that's my preference would be, if I am a long-term holder of real estate, right, I would likely be raising cash today by pruning properties that I've already maximized value and parking some money for the next buying opportunity. That's what I would do. You can't just get in and get out, okay? You know, I would prune stuff where I think I've maximized value and just have money available for when I see some pressure. I can tell you, those of you, I don't like residential real estate in the sense that it has, especially in this class, is there's a bunch of stuff that impacts residential that goes beyond things that are understandable. Like, I don't like the color. I don't like the bathroom. You know, I don't like the kitchen. I don't know how to value that, but it does impact valuation. But I can tell you, yesterday I got the little rag in where I live in Key Biscayne, and I mean, property prices are down 20% from a year ago. So there is stuff happening in the residential markets. You know, people got spooked with when interest rates started going up. Right, stopped going up, but people still got spooked. There's been a whole bunch of new supply, and I think prices, frankly, probably got higher than they needed to get.
Is it 20% from the?
In my little community, it's a very little, you know, it's a very little community, right? And prices are probably sort of out of whack there to begin with, you know. So, and the more telling thing is there's not a lot of activity. So, you know, when I get all this stuff in the mail from all the brokers that are trying to pitch you on stuff, and you look at the volumes aren't there. And volume, at the end of the day, this is a price volume, a supply and demand business. If there's not transactions, it's going to impact pricing at some point, right?
Okay.
Yeah, if you were to park the money, where would you park it? Inflation.
Well, to beat inflation,
Yeah.
I mean, how long do you want to park it?
Until the market drops.
I would tell you today, in this country, it's very difficult to park money and beat inflation. I think the closest you get is, I've been buying short-term treasuries. I've been buying 2 to 3 month treasuries. They're yielding 2.4%. You know, go back to the thing. You can buy a 1 month for 2.4. You can buy a 5 year for 2.1. So I would just short-term treasuries. Now, am I totally inflation ahead? No. But at least I'm treading water, or close to treading water. And that's about the best that you could do right now, I think.
Because if you have it parked.
Well, without assuming risk and having total liquidity, right? So, you know, if you start playing with liquidity and with risk, well, I mean, there's a whole bunch of other stuff you can do, right? I can buy high yield bonds, but you know, then you know what happens if the bottom falls out, right? And all of a sudden I lose a lot of capital. So, but it's very difficult. It's very difficult. Nathan, you had a...
No, thank you.
Okay, so that's it. Crazy stuff. So I get all kinds of stuff. I watch all kinds of stuff. I have a former student that's got me a newsletter, bought me a subscription to a newsletter that I've continued for years, and it's something called Grant's Interest Rate Observer. And sadly, it plays to my preference a very sort of negative credit focus. And it has no pictures in it. You know, it comes out every 2 weeks, and it's really hard to read. And believe it or not, I wind up falling down on the floor in the office when I read it. But they also said like a little daily blurb. And yesterday was listen to this. So this is what's crazy, right? This is what's crazy. You've seen the IPO craze, right? See that? So going back to tea leaves, everybody's got their own tea leaves that they read, right? So one of the things to me that's a sign of froth is when all these companies are in a mad rush to go public. When they have not been in a rush to go public. So I hear something on CNBC the other day. This was interesting, right? And to me this talks back to financial reporting, right? So in the last 2 years there have been 31 IPOs of Chinese companies. Now my concern has always been I don't understand the financial statements of Chinese companies. Okay, I don't believe them. I don't buy them. I think there was an article. I don't know where it was early this morning. It must have been the Journal. I don't know where I read it. I think it was in the Journal, and it says that Huawei invests 15 billion, they say, so the article very clearly said, Huawei states that they invest $15 billion a year in R&D, which is like 3 times more than Cisco does, okay? But it was very clear, it wasn't the company's financial state, it was the company says. And that's all the stuff you get from the, Chinese, People's National Bank and all that stuff. None of that stuff is verifiable. 31 IPOs, 21 of them are underwater right now. Okay, so, and it was like that coffee one, the one that's like, the
Coffee shop.
probably. Yeah, and it's like, you get free coffee or something and all that kind of stuff, so, but
This one, so along those lines, with all this froth, right? With all this froth, here's the stuff from all this froth.
From this grants thing yesterday, it says, this is no joke, and it says that a site called The Next Web is reporting that in Sweden, both for Stockholm and Malmö, there's a company called Kangaroo, with a C, not with a K, which is raised money, and they're going to offer access to pogo sticks so people could walk around, go around the town in pogo sticks. And they said, it's a real venture. We branded it as a product that you can actually use for last mile transportation. I'm not BSing. So when I read stuff like this, yeah, companies that's going to put, so there was the electric motorcycles and it became electric scooters. Now it's pogo sticks.
With training wheels?
So I'm thinking, dude, it's like, you go, and the problem is people give institutional money, asset managers money, and they got to put it to work somewhere. So a guy comes with a crazy idea like this, and then, some stuff is going to make 3x, so you can afford to lose the 1x, and you still have, you still have 2x, right? So, another crazy one, a couple other crazy ones that, I think I forgot to mention last week. To me it was a little distressing. It said that, I might have mentioned it, I don't know, that Fannie Mae and Freddie Mac, more than 40% of the mortgages that they were underwriting and in packaging and selling were to households where the fixed payments were over 43% of the gross monthly income. So now, it's the business cycle. So all of a sudden, there's no credit, and all of a sudden there's a lot of competition. People feel good. People forget what happened, and now we go all the way to the other extreme where people are like, getting highly levered again. Okay, so it's kind of stuff. So, concern there. So I'm listening to again when I drive, I listen to CNBC, and they were talking about I don't know the guy's name. It's like the plastic surgeon to the stars. He does like. What are those sisters? The Kardashian sisters, whatever they're called. I don't even know why they're famous. Those women.
You know why? You know why? You know why?
We're talking about it. Woody Allen had a movie once about a guy that was like famous because he just happened to be at the right place at the right time, and nobody knew why he was famous, but he was famous. And then one day somebody else. And then he wasn't famous anymore, and he was all disappointed. So I don't know why. So this plastic surgeon, he owned a house, and so he decided he wanted to develop a house in a lot he had next door. And so the guy has apparently put in over $80 million into a house. He's had it on the market for $150 million. So apparently, I didn't know this. In LA, there are more than 10 homes listed for over $150 million. The highest one's actually listed for $250 million. So I'm not looking at this because I'm driving and I'm listening. They're interviewing this guy, and he's like, oh, I assumed a lot of risk, and he apparently borrowed all this money. And now he's under the gun because, so what happens? Leverage is good, right? You're playing with other people's money. What happens when your cash flow's not there? Then you lose everything, including what you put in.
Yep.
And so this guy, maybe he put $10 million into this thing, but he's borrowed like 70. And he kept saying, oh, but it sounded like a developer. Oh, but it was my dream. And it was so beautiful. And if you look at the lush landscaping and the waterfalls, and nobody wants to buy it. And nobody wants to buy it. And then the last one I was going to throw here, and this one, this one came from the same newsletter a few days ago. Have you guys seen, and I keep saying, I don't like to talk about residential real estate in this class, but there's a new residential realty firm called Compass. You guys seen that? COMPASS? I've been following a lot of that because in fact, two of my classmates, one of my classmates is kind of like the COO for South Florida, and she's like one of these junkies that, every day she's got like 30 Facebook and Instagram posts. And the lady that's actually running the Compass stuff in South Florida was a couple of years, that's how they know each other, a couple of years older than I am from high school. And so, it's like, they're always having a great time. Everybody's having fun. Outings and everybody's happy and it's like the best place to work. And like, to me, it's like what was that guy, Jim Jones, that people start drinking the Kool-Aid, And I'm saying, I don't know what's up with this, right? So I found out a little bit about this. So it's a couple guys, guy in New York with an Australian guy who apparently has got a history of sort of exorbitant, sort of crazy startups. So they've raised a bunch of money from, who else? SoftBank. Several $100 million. I think they've raised like $400 million. And the company in the last round was valued at $4.4 billion. So it started 2.5 years ago.
Wow.
Valued at $4.4 billion. The highest publicly traded residential brokerage operation is a company called Rhoology that owns a bunch of different brands. I don't know which brands.
It's Sotheby's, Coldwell Banker.
Okay, I know they own a bunch of different brands, but they own like real companies that have historical track records. That's valued, its market cap is $970 million. And so this startup is valued at $4.4 billion. And then it was saying stuff in there like, so they're buying like, you start seeing all these high profile brokers are joining and you're like, why? So this article was saying that they're doing things like, they're giving brokers deals where the house takes no commissions for a year, or the house takes no commission on your first 10 transactions. So, I mean, they're just buying all this volume. Eventually, those are all unsustainable business models.
It is.
And so, when I think there's froth, that's the stuff I read. And so, you can't fool yourself. You can't drink the Kool-Aid. You got to look at stuff. Now, you can't be overly pessimistic either. But you got to start reading the stuff that's happening in our industry or that affect our industry to say, okay, where's volume? Where's the cost? So the cost of debt is very favorable, and it seems to be getting more favorable, right? But what might that be telling us about, the economy in general? What are some of these crazy things, pogo stick stuff telling me, People don't know what to do with the money.
Yeah.
People, yeah, they're, I had these two kids that graduated. One was a football player, the other one was a soccer player, and they're both failures. I mean, no, and I don't mean that. No, I don't mean that. I don't mean that in a bad way. They're both inner city kids. They're incredibly bright. I brought both of them to the school. One to play soccer and one to play football, and they've done nothing with their life. One had a scholarship to run track at a college here in town at St. Thomas. The other one had a scholarship to play soccer at a D2 school in Pensacola at UWF. And if he hadn't started drinking and smoking, he was a Division I soccer player. So they have both now failed out of college. So it's like 8 o'clock at night and they call me. So I'm wearing my PJs and stuff and they're like, Coach, we're here in Key Biscayne. We want to come over and see you. This doesn't sound good. Where are you guys? Over at Sir Pete's. I said, I'll come over and see you guys. So what I'm glad to hear is that they want to get their shit together. They don't have it together, but they realize they're down in the dumps. So, and they're both very bright. That's what pissed me off. I kept telling them, this is pissing me off. You guys you're smart. You're just lazy. So anyway, so the one that had the track scholarship, he says to me, Coach, I want to be a day trader. College, I said, what are you going to trade? I mean, how are you going to day trade if you don't know how to read finance? No, I'm not reading finance. I'm just doing Forex. Forex. So I don't understand macroeconomic terms. So like, he goes, Coach, I made $10,000 on a trade the other day. And he goes, I know that's not a lot of money for you, but for me it's a ton. And I said, he goes, well, it's like a paper account on his phone. And I said, what was your strategy? He goes, I don't know. He said, he grabbed his phone and he goes, look, it's like the Australian dollar or something. Well, the Australian dollar's moved like 3 pennies in the last, How did you make? He goes, well, I don't know, but and I said, listen, Carl, you can't get rich overnight, man. You got to work. And that's the point. There's no quick, if it were that easy, and the other one was smart enough to say, Coach, I think his colleague, I think Coach is trying to tell you, if it was that easy, everybody would be doing it. And that really is the truth. If it were that easy to make money, if we could just flip houses. That was the football player yesterday in the gym. Oh, I'm going to flip houses. If flipping houses was that easy, wouldn't everybody do it? Right? So, anyway. We get that. I want to do this one. This one's an interesting, and I didn't bring a picture of it. I want to do this because we talked the other day about, we talked about some other stuff. I want to talk about valuations a little bit. So, Starwood Reef buys Jacksonville, Florida office portfolio for $230 million. So I went into the article. It was on Globe Street. I went into the article, and it kind of pissed me off because it was our old. We developed, some of these buildings were buildings we developed, and in fact one of them is where we had our corporate office up in Jacksonville. And I love those buildings, they're beautiful buildings. So they're buying off-market portfolio of $230 million for 1.27 million square feet, right? So my question is how much is that worth? Is it good? Is it a good buy? Is it a bad buy? Because we read things like this, we got to figure out. So like, how much is that per square foot, right? I mean, you don't have to get it. I got my calculator. I'll do it. It's $181 a square foot. Is that good or bad? I mean, we should know. There's 4 major metros in the state of Florida.
To compare.
What are the metros in the state of Florida? I mean, there's 25 million, 27 million people that live in the state. Where's the money? Where's the money? So South Florida, it's really 3 metros, right? It's Miami-Dade, Broward, and Palm Beach, right? So let's call that one major metro. What are the other metros?
Tampa.
Tampa.
Jacksonville.
Tampa. Well, you missed number 2. You guys jumped number 2. Orlando. You forgot about that. Second largest market in the state of Florida. Is there another major metro?
Jacksonville.
Yeah, Jacksonville is kind of, we had a lot of stuff in Jacksonville. Jacksonville is the last place you go before you go to India or Vietnam or whatever. No, I mean, listen, and the Economic Development Council there says that. No, the problem, listen, Jacksonville's a great place. The problem from a real estate perspective in Jacksonville is there's a bunch of problems. Well, the single biggest one of it is it's like Atlanta. There's way too much land. So, if you buy something from somebody who developed it, what's he going to do with the money? He's going to buy the land next to you and compete against you and take your clients and he cultivate it. And the other problem is, you've got relatively strong economic development agencies there. So there's a bunch of excess land. There's an old Air Force base. There's land by the port. And so the government's always giving land to people, and so it's a tough market, it's a tough market. It's a nice market, but it's a tough market. So is $181 a square foot good or bad for an office building in the state of Florida? What's replacement cost? You're a construction guy. What's it cost to build a suburban office building like we talked about the other day?
The minus the land?
Yeah, let's go X land. Without the land. Yeah, I mean, you may not know it because...
No, I think probably like 225.
So I mean, it's going to be way north of 200.
You can barely build a house for 180.
Yeah, well, so it's going to be way north of $200 a square foot, and probably not even counting the land. Now, what did we say coverage was for office the other day? What did we say coverage was for office? What's coverage? Yeah, but I mean, like, what was the coverage for office? So it depended if it was structured or if it was surface part, right?
Yeah.
Assuming it was surface part, what did we say was?
80%?
It was lower than that. It was lower now. We said industrial was probably closer to 50.
Oh, 25.
20 to 25, right? 20 to 25. So if we say that we've got, what do we say, there were 25,000 square foot footprints were probably optimal, right? So 25 by, let's use 20%. So you need like, you need 125,000 square feet, right, altogether, right? So that's what, 3 acres, right? What does an acre of land cost in Florida? Depends, right? Depends. Developable in a major metro. I mean, it could be a lot of money, right? I mean, maybe, I don't know, what do you want to put in Jacksonville? What do you want to put? $12 a square foot, right? Times 125,000. So you're easily going to have, you know, another million and change in land. Call it $2 million in land, right? And that's in Jacksonville, right? You know, so you're going to be well north of $200 a square foot, but it's being sold for 180, and that's a problem if you're a developer. And I think in most markets, in most asset classes in Florida, because of the price of land, it's much cheaper to buy cash flow than it is to develop. So that's one thing I want to, you know, it's quick and dirty. You read an article, okay, 180. Now, can we infer a cap rate on that? Do you think we can calculate a cap rate on that? No? Why not? We need, okay, well, what should operating expenses be in an office building in Florida? Suburban office building in Florida? We should have an idea, shouldn't we? Michael? Yeah. Okay.
I concur.
Does anybody, you're a property manager? Oh, you're a multifamily, you don't know. Hold on, he's got an idea.
5%?
12%. We don't usually quote in percents when we talk about operating expenses. We talk in dollars per square foot. I heard $12 square foot. That's a good number. Might be 9. It might be 10. It might be 12. What would it be in a central business district office?
12 to 16.
16.
Okay, Aaron just answered. It depends on the amenities. Typical office tower downtown. You've got a concierge. You might have security. You know. You could probably double it. You could use $20 as a proxy, but you could probably double it, right? So let's kind of just walk back to what somebody should pay for this to be a market. If we say that operating expenses are $12 a square foot, right? What do you think gross rents or full service rents are in suburban office product in Jacksonville? You said 30, you said 25.
I like 30.
You like 30. What are they in South Florida? I've got a styles guy here. I mean, come on, talk up, speak.
35.
Here in South Florida.
Yes.
Right, do you think Jacksonville, if it's like the last stop before?
It's probably 22 bucks.
No, it's not 22. No, let's just throw a number. Just to make it easy, let's throw 30, right? Let's just do some math, right? So what would net rents be? 18? I mean, do I need to put this up here and then do that? So net rents are 18.
Certainly help you.
Okay? I mean, come on, it doesn't really matter, you know? 18. So what would the implied cap rate be if what we just assumed is right? What's cap rate? What did we say cap rate? Well, we said that the other day. It was one of the definitions we went through the first class. Cap rate? Cap class. You guys want to do jumping jacks or something? Cap rate.
Net income divided 12. No.
Go, let's go. Net income or net operating income,
Operating income.
right? Over what? Over value or purchase price, right? So what would it be? Does that sound like a good purchase now, maybe? Now, maybe rents aren't $30. My guess would be rents are not $30. My guess is probably rents are about 25, okay? maybe that's 13, and then that's gonna push it down to 6-7%. Which is probably where suburban office product is trading in a market like Jacksonville. That would be my guess, okay? But we read a little, we read a little blurb, and now we can start putting together some math in our mind and say, oh, that's a good deal. Oh. Or you get a teaser in the mail, and it says, you know, we're selling a 1.2 million square foot portfolio, and hey, we think we want, you know, $200 million for it. Maybe that's an interesting buy, or maybe it isn't an interesting buy. Okay. So, and then as a developer, you're just saying, well, should I develop? I mean, can you develop a new building in Jacksonville based on what we just went over? No. I think it'd be a hard sell. Now, definitely on a speculative basis, it would be a hard thing to do. Okay. So I want to do this real quickly with industrial, and I haven't done this one. In fact, I hadn't done this one either. I just said let's do it, and there was another one that. So there's the Singaporean sovereign wealth fund. What's a sovereign wealth fund? So a country takes some of its resources and puts it into essentially a private equity fund for the benefit of its people. So Norway's got one. They take, you know, a portion of the royalties that they earn from oil, and you know, Singapore's got one, and so they're apparently the second largest industrial portfolio in North America, and they're selling it. I mean, that should tell you a lot.
They're selling it? Second
Largest industrial portfolio, private equity portfolio in North America, and they're selling it. So it's
They must know something.
so some people say, so Blackstone and Prologis are vying for it. Who's Blackstone? We know Blackstone's a large private equity
The
group, right?
private
Who's Prologis? Industrial what? So it's an industrial REIT. Yeah, I mean, they do develop, you know, we'll talk a little bit about REITs. I was going to do taxation today. We're not going to do it. We'll do it next week. Well, you want me? I can switch it. REITs have an ability to develop under something that's called a taxable REIT subsidiary, but it can really only be very small components of their activity. Because again, REITs have to generate passive income, and development is not passive income. Rents and interest on mortgages for buildings that generate rent are passive income. And so, so Prologis does develop a little bit. They've developed a little bit down here, but they tend to have strategic alliances with developers where they will either partner with them or just take them out. Okay, they'll let the developer go through the whole development process, and they'll agree on a price based upon the underlying rents, the cash flow from it. Okay, but so the building, the business is 200 million square feet across 1,350 properties. What are some of the things that this is telling you? I haven't even gone anywhere yet. What's one of the things it's telling you? What's that telling you? What would it tell? What would be the first ratio that I would draw?
Price per square foot, price per unit.
Well, I haven't given you price yet, have I? I haven't given you income yet. 200 million, I've just given you 200 million square feet, and I've told you it's 1,350 properties.
Average size.
Yeah, so it's a box that's about 150,000 square feet.
Oh, that's not a dollar sign.
Oh, sorry. Excuse me. I messed up. Okay, what does that tell me?
How big the units are, they're small.
I understand. That's a small bay?
150,000?
Yeah.
No, that's pretty big.
Yeah, so that would tell me that's an institutional size industrial box. And it's going to be for big box users, okay? So, I mean, if you're in like Medley or Hialeah Gardens or something, you know where Hialeah Gardens is? You ever left Broward County? Do you have a visa to go to Hialeah?
I just work in Hialeah within a...
You work at Hialeah?
Yeah, right.
En Mamaroca. All right. So what would a typical industrial bay, you know, the small users, right? So How big would a box be there?
Just like one unit
The building, how big would the building be?
in Hialeah?
Yeah.
Those are big ones.
No, small. So you're probably gonna have max 50 to 75,000 square feet, and you're gonna have bays that are gonna be how big?
10,000.
3 to
Not smaller
10,000.
than 2,000.
Yeah.
Probably 1,000
Yeah.
to maybe 3,000 square feet max.
Yeah.
There's small business communities. I mean, if you go to Vero Beach, do you think you see 150,000 square foot warehouses? There'll be 2 or 3, right? You know, I mean, I think in fact there are, like CVS has a huge, you know, box distribution box there. A little further south of there, I think Walmart's got a big, really closer to Fort Pierce. Pursuit Boats is down there. But for the most part, you don't see this. You see this kind of stuff. Because if you're an air conditioning guy, if you got a little machine shop, right? If you're a distributor of, you know, whatever products, how much space do you need? 1,500, 2,500 square feet. How long a lease do you typically sign when you're one of these guys? Maybe 3 to 5 years, right? Not a lot of sophistication. People want to have the flexibility to get out and move, right? Is the credit really good here? Probably not. So this is not institutional grade. Now, go to Medley. Go to Doral. What size boxes do you see?
1 million.
Well, but you don't see. So nobody wants to own a 1 million square foot building. For the most part, you will not see institutional buyers want to own a million. So there's too much risk associated with one. So there's certain sizes, because at the end of the day, we want liquidity. We want something. What's the first question you ask yourself when you buy something? Who am I going to sell it to, or how am I going to sell it, right? And so a lot of times, you're not going to buy stuff that's too far outside a particular pattern that's going to be institutional in nature. So how big are industrial boxes for credit? The opposite of this. Credit type national tenants. So they're going to be 100 to 200,000 square feet, okay? 100 to 200,000 square feet. Maybe in some markets they might be a little bit more, okay? You might see a single user in these. You might only see 3 or 4. You're not going to see 30 users in there. What's the profile of these guys typically going to be? They're going to be national companies. How long are the leases going to be there?
10 years.
Probably 5 to 10 years, right? They're going to have credit. They might have expansion, you know, rights and things like that. And so all of a sudden, just the fact that the average property is 150,000 square feet, it's already telling me it's an institutional, you know, grade portfolio, right? Now we can add some stuff to it. They want $20 million for it. Or, I'm sorry, what did it say, $20 billion?
20 billion.
For the entire company.
Billion?
Billion, including debt, which you have to include the debt, right? So, how much is that per square foot?
Oh,
20 billion.
it's a lot of zeros.
$100? Is that good or bad? Let's go to our resident construction guy. X land. What does it cost to build an industrial box in South Florida?
Hard cost. 980.
Now, I'm a little bit out of the market. That's high, but it might bump. But it might be. I mean, I think X land, you're probably in hard and soft in that range.
Yeah.
But it definitely doesn't cost $100 a square foot.
Like coal box or?
No, just a regular, you know, 200,000 square foot, you know, 32 foot high.
No, 120.
Okay, so, you know, 120 plus land, you're gonna be with land 180, you know, maybe 200. So, you know, so now the problem is some of this stuff might be where?
Okay.
Tertiary.
You're like
Out there.
in the middle of nowhere, right?
Kansas.
Okay. And rents are gonna be, you know, what, right? So what are typical operating expenses? What are typical operating expenses in an industrial building? Low, okay? Okay, is it lower than a bread box? No, is it lower than an office building?
Yes.
Yes.
Yes, why? Because like we're not cleaning, right, we don't have all this air conditioning, right? There's probably less insurance, insurance is gonna be less. So, how much is it?
$5.
No, 10.
Oh, she likes 10.
Yeah.
No, I mean, I would tell you probably 3 to 4, okay? 3 to 4, yeah. What are industrial gross rents for a big, what are industrial gross rents in South Florida for a big box like this?
Didn't you do Beacon Lakes?
It could be Beacon Lakes.
Didn't you?
Did I? Yeah, I worked for Kadena, yeah. So we developed Beacon Lakes, yeah. I mean, we actually acquired the land and titled it. Before we entitled, we brought it into the urban development boundary, then entitled it, and then started developing it, yeah. Did you? Cool.
Very interesting.
Yeah, very good. This is years in making, a lot of years. So let's say $11, $12. Let's say $12, right? Okay. And if operating expenses are $4, what are net rents? $8 a square foot. So if those buildings were in South Florida, what would the cap rate be? 8%. Would those buildings likely be in South Florida?
No.
At $100 a square foot? Probably not. They'd probably be selling at about $200. And what would the cap rate now be? 4. Yeah, and that's kind of 4, 4.5 is probably where industrial cap rates are in South Florida. But I don't know if this is of interest to you, but if you guys want to work in the real estate industry, these are the type of relationships that you need to understand. You could do the same thing with multifamily, okay? You could do the same thing with retail. But you got to start connecting the dots, all right? And that's why, having financial skills and playing with numbers opens up your mind in the development game, in the portfolio management or asset management game, right? In the institutional money management game, so in property management, so we got to know all this stuff, guys. I mean, I would suggest. So anyway, that's I don't know. Let's see if there's. I'll skip this one. I always keep bringing this one, and I keep skipping it. No, because we'll do that another day. Here's an interesting one. So retail. So for years, when I first started here, when I first started teaching, Amazon was like always I hate Amazon. I mean, I hate Amazon.
And you use it.
I use it a lot now. Just because it's easy, it's easy, okay? And, but the question I always had, I used to teach a class where I would always assign something called retailing and real estate. Now, there was an old article that I would give out, and I would challenge the students to try to draw relationships between what was happening with retailers and what was happening with retail real estate. Because that's what I care about, right? I don't really care how Macy's is doing. I only care how Macy's is doing to the extent that Macy's performance is going to impact the rents that I collect, right? And so, the question is what's happening, what's happening, and some of the questions that I'd ask to help, what's happening with online? Now I'm going back 10 years. What's happening? At the time, Amazon was still a significant money loser, right? But they were starting to suck up at the time close to $100 billion of sales already from the retail market. So stuff was happening, and we roll the clock forward now to a point where you've got things like Amazon is a significantly more important or larger search engine for retailing than Google is. So Google was the preferred sort of search bar for people. People go to Amazon now because they figure Amazon's got the product there or they've got a relationship. And so there's all kinds of things happening in retailing. Now I don't care about that. I'm not a retail guy. But you got to understand what's happening there in order to understand what's happening in the retail space. Now, on the good news side, Best Buy this week beats forecast with strong appliance and gadget sales. Target booked strong quarter with growth of new brands. those seem to be two companies in particular that have found ways to attract users or customers to not only go to their stores, but also sell online. So, you know, whereas I think for a while Best Buy was losing sales, especially their, like, you know, easy electronics to Amazon, they're starting to get that back. So I don't know what the answer is in retail. I don't know that anybody knows. Everybody's got an opinion, everybody's got an idea, but retailing is a huge chunk of commercial real estate. And so we need to understand what's happening, and we need to understand where there's risk and where there's opportunity. Okay?
Best Buy is survival.
Well, it seems to be a survivor right now, right? But then, you know, there's a company called Ascena. It's they own a bunch of brands, but it's like all these brands, like these teeny bopper brands that, like, you know, it's like, I don't go to malls, I get very nervous, you know? And when I go in a mall, there's like all these stores, and there seem to be like all these little 13-year-old girls in there buying beads and jeans and stuff. But they, I know I'm exaggerating, okay? But they so Ascena owns a bunch of brands of, you know, in retail, like, what's another one, like, Limited owns a bunch of brands that, you know, even, what's the one where it smells a lot when you walk? Abercrombie. They own another one too. Hollister, right? So all these people own, you know, they own different brands. But anyway, Ascena's just closed a bunch of stores, you know, and so there's a lot of stuff going on, right? There's a lot of stuff going on, and it's impacting. And the people that survive will be the people that innovate.
Yeah.
Okay? What are a couple of things that I like to bring out? So I remember reading an editorial in The Economist some years ago, and it said at the time General Motors was the largest market cap company in the world. At the time. So at the time it was like, you know, Exxon, General Motors. And they said General Motors is, you know, largest corporation in the world. You know, they have an annual forecast, they have a 5-year plan, but the reality is if you look at the real order book, it didn't go out more than a month. Firm orders that they could actually stuff down to their dealers. Beyond that, they have no visibility. And most companies, there's exceptions. There are exceptions. But most companies don't really have firm sales commitments beyond a very narrow window. Okay? And so you can't ever just sit back and think, hey, everything's going to be peachy here, everything's going to be good. And real estate is one of the ones that are impacted by it. So you could do it, you know, whether you use, just the fact that I'm going to use this term, Fortune 500, does anybody ever even use that term anymore? There was a magazine called Fortune, which is like a big money magazine. I don't even think the magazine's it. But when I was young, when I was in college, people talk about the Fortune 500. People talk about the S&P 500 now, right? But if you were to go back and say, of the 500 largest or highest market cap companies, I don't know, 1960 through today, my lifetime, right? What year are we in? How many companies do you think were here that are still here?
Very few.
Not many.
Maybe 5.
Well, more than 3, man. Come on. But not a whole lot.
GE is the survivor.
Not a whole lot. You know, and there's a lot of natural, there's cannibalization, right? Where one company buys another one, right? But the reality is, I mean, the example I always like to use, and now, it's probably even a bad one, but, so it's 1982, I get out of college, right? And the PC came out up here, up in Boca, you know, I mean, there was already the Apple, there was already the Apple IIc and all that kind of stuff, and there was the Commodore, you know, and the Atari box, and the Trash 80 from Radio Shack, the TRS 80, you know, there were all kinds of like little things, right? But in '82, you know, all of a sudden it really got big because IBM came out with their first PC, and then, but something interesting happened that year, and IBM spun off their typewriter division. So, has anybody ever used a typewriter?
Yeah.
Okay.
I do.
What's that? Yeah. No, but so, you know, when I was in college, we typed paper, thank God for erasable paper, because, you know, you make a lot of mistakes, right? Now it's easy with a screen, but, so IBM spun off their typewriter division. At the time, one of the largest companies, one of the, well, S&P or Fortune 500 company was a company called Smith and Corona. Corona. Does anybody know what Smith and Corona did? They made typewriters. They made typewriters. Do they exist today?
No.
They do not. So the IBM typewriter division figured out that a typewriter was really like a keyboard and a printer. And so they rebranded themselves as a company called Lexmark. Now they're not that, you know, big anymore. But at one point they were like the second largest printer, you know, manufacturer out there, and accessories. So these people figured out that the typewriter didn't exist anymore, and they needed to change their business, and they needed to evolve, right? These people didn't figure it out.
Like Kodak.
And well, I'll tell you a story. I was running a company up in Rochester, New York many years ago. We bought a company up there, and I wound up running it. I got stuck running it. I would commute up there every week. I'd leave Monday afternoons and come back Friday nights if I could. If not, I'd stay 2 weeks at a time. And it was a printing facility. It was a beautiful, probably the highest quality printer in the country. We did all the annual reports. Nobody prints annual reports anymore. And all the annual reports for companies like General Motors, like Ford, like Tiffany's, like Bristol Myers. I mean, it was a beautiful, incredible experience. Great people up there. There were about 400 people in the plant, and because we were in Rochester, we weren't a beta site for Kodak. We were an alpha site. When they were developing stuff, they would use us. I mean, we were, you know, the largest printer there. We had a long. I mean, this company, you know, went back to like the early 1900s, so it kind of grown up with Kodak. And so we bought it. I got stuck running it. And somehow my boss hooked up with a guy that at the time was the chairman and president of Kodak, a guy named George Fisher, who had come out of Motorola. So you figure Motorola was a high-tech firm. This guy was an engineer. He got brought on to Kodak. Now this is 1992, 1993, sometime in that time frame. And so George Fisher came to visit us at the plant. And I actually have somewhere at home, I've got a picture, I'm in the front page of the Rochester Democrat and Chronicle, you know, showing George Fisher, you know, our plant. But I'm walking around with George Fisher, and I asked him, I said, I didn't know even the right question to formulate. I said, well, what are you guys doing with digital technology? And we had an older guy at the plant that was really a visionary, and he was always hyping stuff to me, and he says, what do you mean? I said, yeah, like putting stuff on CDs and all that. And he goes, we're not going to waste our time with that. And it doesn't exist. So, and those were decisions that people made. I mean, I didn't read that anyway. I lived that one. I was like, I thought that guy was really short-sighted. And this guy was like, chairman and CEO was probably 25, S&P 25 company at the time. It doesn't exist anymore. It exists in that it owns some patents and stuff like that, but let me see if there's anything here. The debate intensifies about the use of interest-only loans and CMBSs. Again, another push into, you know, relaxing, you know, lending standards, right? So now you're not getting principal back. You're loaning money, but you're not getting principal back. Digital Realty Trust. Does anybody know what they do? So there's a bunch of niche REITs out there that they do data centers. And so they just bought, this is kind of interesting, they bought a 13-acre parcel in suburban DC in Virginia.
What's it called?
Yeah, what is it called?
DLR, Digital Realty Trust. There's 3 or 4 in that space. There's Digital Realty Trust. There's another one called Equinix has now become a REIT. There's another one called, I forget now. So one of the things that you guys should do, and I hope that those of you who attempted the case study would have done, is you would have gone to a listing of the companies that are publicly traded in particular sectors, and then you can see what they're involved in. So you could go to any one of like your brokerage accounts or Yahoo Finance or Google, and you can get a list of the 250 REITs in this country, and you can see what they specialize in. Or you can go to, under consumer durables, you can go to home builders and get a list of who the home builders that are publicly traded are. So you don't have to try to imagine or just go to Google and say, home builder, you know? You can actually, you know, find out what they are. But there's like 3 or 4 of them. Yes, sir.
To research or read more in depth, what would you recommend other than Google?
Okay, why don't you stick around and do the case study this week, and you'll see one way to do that. I'll give you a very good tool. The single biggest tool that you have is what's called a supplemental report. Almost all REITs publish on a quarterly basis supplemental reports. They file them as 8Ks, and they give you a tremendous amount of what is non-GAAP information. So it's not information that is required to be disclosed by GAAP or even by the SEC, but it's information that they choose to put out in order to help readers understand their business better. Okay?
Are genuine on those reports?
I would say they're pretty good. I would generally say that in this country, generally speaking, most publicly traded companies tend to do a fair job in providing. There are instances where you find fraud, but for the most part, you tend to get very good, you know, financial information. Some REIT, one second, Ryan. Some REITs, so REITs tend to report like one another. So the multifamily guys tend to kind of produce the same stuff. The office guys produce the same stuff. The industrial guys, some are better than others. I think some of the retail guys do a great job. Some of the office guys do a great job. I think multifamily does a poor job, personally, but they get away with it because their peer group, that's what they publish, okay? I won't go into this one. We'll do this another day, but it says, shortage of affordable houses drag down sales. Affordable houses. We'll talk about housing and affordability another day. Okay? Yep.
Sure. Is that similar to workforce?
I'm sorry?
Workforce and affordable?
Workforce, you could use, you could use.
Interchangeably, or?
I don't know about interchangeably, but I think they're similar concepts, okay? It depends, yeah, it depends what, there you go, we got the
Zoning.
we got the planning support here. Depends what you wanna call. Yeah, but ultimately my comment towards that is there's an article in a daily newspaper in Barcelona yesterday that said that rentals have paralyzed in the city. And the reason for that is that there's there was an issue, a law that was, or a bill, the equivalent of a bill was presented in the autonomous government's parliament this week that was going to cap interest rates, rental rates. So, you know, we've got a history in this country. There's still some rent-controlled apartments in places like New York, maybe Boston, maybe Philly, maybe San Francisco. So again, the whole issue is the governments have tried to address home affordability in a variety of different ways in different parts of the country, but and that's probably where there's excesses in capitalism. But you got to get to you're definitely going to constrain value if you put caps on rents, right? But then the other side of that is you got you're in government, you're there to provide for the people. So one second, I had Ryan first, and then you.
I was asking about what are the mandatory filings for a REIT, because you said that the supplemental.
We went through 3 or 4 mandatory. So you typically have, anytime securities are issued, you're going to have an S1, an initial registration statement. You've got an annual report, which is the 10K, and you've got a quarterly report, which is a 10Q. You've got the 2, 3, and 4 filings related to stock transactions of officers. You've got the 14As, or the DEF 14As, which are proxies anytime you're soliciting shareholder votes on anything. And then you're going to have 8K filings anytime there's a significant event. Okay, now what's a significant event? You're going to leave that up to the company. If management makes a presentation somewhere at a private, semi-public venue, they're going to share that. There's a major contract with a customer, a hiring, a firing of a key executive and all that. So any sort of special event is going to fall under an 8K. These supplemental reports are not mandatory, but they choose to do that. Very few other industries offer that information.
Would you get property level performance ever?
Some are very detailed at a property level. So for example, where I said multifamily doesn't do a good job, they do an incredible job in going property by property and giving you things like monthly rents and doing it on a same store concept. So do we know what same store, like what does same store mean?
Comparable?
What, terrible? What?
Comparable.
Yeah. So same store would be, so we talked about revenues are typically driven in any business by two things. What are they?
Increasing
Whole
prices
store and same
or
store.
decreasing costs?
Well, no, revenues, top line.
Quantity or.
So price and volume. Okay? So, you know, in real estate, right? In real estate, if we want to put this in real estate and you're selling apartment space, right? If you want to put it that way, what are your revenues going to be derived from? Your monthly rent, right? Your gross revenues are going to be from your monthly rent times how many square feet or how many units you have out there, right? Right, so units are volume and your monthly rent is price. Now what happens, the easy way to, if you just disclose one number, which is revenues, the reader, right? The reader doesn't know how much is price driven, so how much pricing power do you have, and how much of it is because you bought a lot more units, right? And so one of the things that a lot of the REITs do is they'll break up and they'll essentially give you same store comparison. So they'll say, in year X1, we had these 300 units, which we also have in year 2. Now, additionally, we built another 50 units, okay? Or we bought another 50 units, which gave us some incremental revenues. But what this same store view allows you to do is really take a look at what's your pricing power in relation to the comparable units in one period to another. Retailers tend to provide that information as well. Any rapidly growing company, yes?
And in the Wall Street Journal assignment, assessment, whatever it was, the Home Depot article covered same store.
Same store, retailers, yeah.
And they said it was strictly for stores that were open for over a year. But is it, like, do they narrow it to, like, we're talking about a tiny Home Depot or a large Home Depot?
Well, I don't think in the case of Home Depot, and I don't think in the case of like large retailers like that, like Target, that they're going to say, well, they could break down and say our superstore,
right,
same store sales or X versus ours. But no, most people just tend to be more generic and say, hey, the comparable set in period A and B, our pricing power was this.
Gotcha.
Okay, so that's kind of how people. But so you'll see that in retailing is an area where that's you know, that's a common concept, but it's very applicable in real estate as well. Okay, because it, you know, going back to its comparability. Okay, so yeah, overall revenues went up, but I had a lot more units and my pricing power went down. That's probably not a good sign. Okay, because I'm deploying capital, but I'm yielding less. Okay. Okay, so let's get into some accounting stuff. I'll do this one quickly, I think. Yeah, great. Come on.
I had a question.
Oh, I'm sorry, Nathan.
No, it's okay. Just, you talked about the Spanish, it was
The
Barcelona?
Yeah.
And in Barcelona, they're restricting, you said they were.
There's a project, there's a law in the courts in the parliament to restrict rents.
So they know by restricting rents, that's gonna reduce the.
Impact value.
Yeah, they impact value, plus, which will reduce any new development because it's likely, right?
Potentially, right.
Potentially. So they have an aim, and it's probably not just for controlling rent, right? They may be trying to control sprawl too.
Well, I mean, the reality is that, I don't know, have you been to Barcelona?
Yeah.
So you've got the Vidal on one side, you got the Met on the other. There's not a lot of there's not a lot of place to go. So in their particular case, they're trying to address you know, affordability for people, right? I would probably say on a land use perspective is where people would control sprawl and just outright limit for whatever the reason, right? And it could be, you know, these are sensitive areas, there's animals here, or, listen, I mean, we've had development moratoriums in places like Dade County because we don't have water and sewer capacity. I could tell you, we own some land in Lakeland, which really was primed from a state distribution perspective because it's very centrally located and cheaper than Orlando, which is probably a little bit better. And who's in Lakeland, by the way?
Only people.
Public.
From our real estate perspective,
Public.
Publix. Publix, you know, largest retailer in the state, really. Okay, so and they're able to, you know, cover the whole state from Publix. But the problem that we had in Lakeland was the cost of paying for the upgrades to the water and sewer plant in order to get the development rights. So there's a lot of different ways that municipal governments can control sprawl. That isn't, you can try to affect values. I think that may be politically more convenient because you get a lot of voters that way. And there's municipal elections Sunday. So the timing of the bill was not coincidental. Okay? But you can restrict, you know, development in a lot of different ways. Yeah, you can also just impose, you know, higher impact fees. You know, there's a lot of different ways to get to that controlling. Yeah. Okay. We talked last week about several areas that were either unique in real estate or that because the way real estate operated that we had to be careful or be sensitive or have a greater understanding of financial reporting related to, you know, either those entities or transactions related to those entities. And we talked about leases because leasing was a very important structure. We talked about sales and revenue recognition. Is it a sale? Is it not a sale? We talked about development costs. My goal today is to cover those three areas, okay? And I'm going to do leasing first. Now, I spent a whole day on each one of these areas, and I'm going to try to do this quickly for a couple of reasons. One, because I'm not sure that most of you really care that much. The other one is we've seen a lot of transition, and so leasing we've gone. This is the first time that I've gone from standards issued in 1979, FASB 13, to the statement that was issued in 2016. So as of December 15th, any company whose year end starts after December 15th of last year must now utilize the new accounting standards related to leasing, and are radically different, okay? Revenue recognition, we're in a transition period, and I'm not sure where that's going to wind up, but I think it's important to take a look at least concepts that we can take and say, hey, okay, I get it, I understand it, I know why I need to apply it. So, you know, a background, first thing, we talked about, what's a lease? A lease is a right, in this class is right to use real estate. We defined real estate already, right? Land plus improvements are on. So a lease is a right to use real estate for
A certain period
a
of time.
specific period of time, okay? So it can't be open-ended, okay? It needs to be first. Now, being more specific about the definition of real estate for leases, so yes, it's buildings and improvements they're on, but when we talk about leases, there are typically, I want to say there's 3 or 4 areas in which we lease real estate. We can lease land. We can lease land and buildings. We can lease land, buildings, and furniture and fixtures or property and equipment, right? So sometimes you talk about cold space, sometimes you rent an industrial box that has cold storage, and so you're renting it with all the mechanical equipment in there. You might rent office that has furnishings in it already. You know, I've seen leases where people have laid out, you know, modular offices, and people rent that. If you really think in the context of the Regises or the WeWorks of the world, you're renting it even with maybe computers, maybe with phones, okay? So land and buildings, land, building, and furnishings, right? Or part of a building, a certain floor, for example, or certain floors, okay? So that's typically where you're going to see leases. Now, in accounting, we always try to follow the substance of a transaction and not the form. And I mentioned the other day, I use a term called a synthetic lease, okay? Leasing, I want to propose to you guys that leasing is nothing more than a form of financing. And you may not look at it that way, but let's use a basic example. I can go to the Toyota dealer and I can buy a car. Or I can lease a car. At the end of the day, I'm getting the use of the car, right? If I buy the car, what am I doing?
Build equity?
Well, I'm paying for it.
I'm paying for it.
If I'm leasing the car, what am I doing?
I'm just paying for it.
Somebody's paying for it,
And
I'm repaying them. So, let's expand it. I can buy, right? Now, if I buy, I can pay it cash, right? Or I can
finance with credit.
go to a bank, right? The bank buys it, right? They hold on to the title, and then I pay the bank, right? Leasing is kinda, right? And there's usually a financial intermediary, which is usually some sort of bank, in the middle, right? Leasing, and kind of the sort of odd thing with most leases is you don't typically get title at the end, okay? Or you may not get title at the end, okay? But sometimes you do. Sometimes there's a bargain purchase price. Sometimes there's a fixed purchase price. So a lot of different ways. But leasing is a form of financing, right? So in the context of real estate, it's no different. I can buy a building. I can buy a floor in a building. I can buy a suite within a floor in a building. Or somebody else owns it. They're the ones who finance it with a bank. And I just pay them a rent. And so I could carry the debt of the real estate on my books, or I just pay somebody a monthly payment. Right? So I can borrow the money. And ultimately what leasing in this country, and especially as it relates to real estate, it talks to efficiency of capital. Where do we want to deploy our capital? Do we want to deploy our capital into real estate, or do we want to deploy our capital in our business? So do we want to finance our working capital? Do we want to finance our machinery and equipment? Right? Do we want to finance our research and development? Or do we want to finance the building that we occupy? So we just kind of said that a 200,000 square foot box in South Florida could cost $200 a square foot. So if I need to occupy that space, how much money do I need to have to buy it? 40 million, right? So I can deploy $40 million of capital to occupy that space. Or what did we just say we could lease it for? $12 a square foot times how much? 200. 200 is how much per year? 2.4 million. So my option is I can pay $2.4 million a year to occupy the space, or I can pay $40 million to buy it. And in this country, not in other countries, in this country, from a large perspective, most companies choose to lease space. Why?
Taxes.
Deduction.
It's better use of capital. Because now you're not putting $40 million in this building. Now I can finance receivables, I can finance inventory, I can do R&D, right? I can do marketing, right? I can finance whatever equipment goes in there, okay? And I've just freed up a whole bunch of capital to do all these things. And there's some guy that's willing to buy this, right? And essentially buy it at a 4 cap. He's assuming a very low return, essentially, and I'm hopefully going to get a higher return for that money. So in real estate, in this country, something like 70% of institutional industrial space is institutionally owned. It's not owner occupied.
If you could buy it at for basically the same money monthly, would you buy vice rent? But isn't it?
Look, I mean, ultimately, a buy-rent decision, I mean, it's a capital, it's a net present value solution, right?
Yeah.
So you could sit down and say, okay, you know,
Or annual, I guess.
hold on. You can do this in your net present value, right? At 0, right? And then, right? So you can do your net present value under either scenario. The question becomes is, if I don't pay this, what can I deploy this and what does it produce? That's a financial thing. Now, you go to Latin countries, or you go to Latin businessmen in this country, and they're going to say, we're going to own a real estate. That's part of our legacy. They don't even think about it. You know, that's mine. You go to a place like Germany, right? And like nobody owns real estate on a residential level. And in industrial, everybody owns it. It's owner occupied. There's very little industrial occupied, institutionally owned space in Germany, for example. I'll talk about it. In Germany, you've got a small country, relatively small country. You can distribute to the entire country from your main plant. So you don't have to, like, you know. So there's a lot of different reasons, but it ultimately becomes personal choice. But in this country, I'm telling you, it really is a more efficient use of capital to invest in your business. Hopefully you've got a higher return on your business than what the return you're going to get on the real estate is, essentially, right? Yeah. The other thing is that it's flexibility, right? So I can go to you and say, I need 80,000 square feet today, but I want an expansion option for another 20,000 square feet here in 3 years. Or you know, you're Beacon Lakes, and I know that when I grow my building, there's another building next door where I can get another 40,000 square feet. Okay? And so there's a flexibility component, right, that when you buy something, you're kind of stuck there. Now, if you're a manufacturing business, those tend to be the industrial buildings that are owner-occupied, because they're usually manufactured for a specific purpose. And they're likely not going to be used by anybody else. And an institutional owner is not likely going to want to own it and rent it to you. Because the day you blow out, what do they do with it?
Nothing. They have to remodel.
Well, they got to spend a whole bunch more money to try to, you know, make it suitable for somebody else. So, you know, in this country, the choice has been to lease. Okay? And leasing is a financing transaction. Now, what happened for many years from FASB 13 on, and I'm not going to go through all the rules, okay? FASB 13 went through these 4 rules of, you know, does a lease, does it occupy, you know, is it more than 75% the economic life? Are the minimum lease payments more than 90% of the present value, of the value of the asset? But basically what was happening is certain companies were taking advantage of the leasing rules that were promulgated to not record an obligation on their financial statements as a lease. Now, what does GAAP say? GAAP says, hey, that lease is really just a form of financing. It's kind of like if you bought it, okay? And so you've got to recognize all of your future payments as debt on your balance sheet, okay? And so I'm not going to get into the journal entries so much, but suffice it to say that in old days, in the old accounting, there was something known as a capital lease and something known as an operating lease. And anytime a company that occupied real estate, you know, met these thresholds, they would have to create under fixed assets something called capital leases, and they would have to create within their liabilities obligations for capital leases. Okay? So that a reader would know that this company has long-term obligations under capital leases. And that's essentially debt. Okay? It's as if you had gone to the bank and borrowed the money. However, companies like CVS, Walgreens, McDonald's were circumventing these rules by creating these odd lease structures, okay? And I think companies like CVS had like $4 billion worth of debt that wasn't recorded on their balance sheet. So a lot of times when you were looking at retailers, they had huge commitments for occupancy costs that weren't reflected on the face of the financial statements. Now, an astute reader like you, who knows that there are 5 important components in a financial statement, right? And the last one was what? Footnotes.
Footnote.
Anyone who know that you could go to the footnotes in the olden days and figure out what those obligations were. So you could quantify them, but if you just looked at the face of the financial statements and you were looking at debt to equity, if you were saying who's got money at risk here, you would never have been able to identify that these companies were obliged under these long-term commitments. 3 years ago, a new accounting pronouncement came out. They no longer call these things capital leases. Okay? These things are called finance leases. And the long and the short of it is that essentially all companies have to capitalize their lease obligations. So on the face of the financial statements, they're going to have to recognize their long-term commitments under lease obligations as both an asset and a liability. And when you pay your monthly rental income, instead of saying you're going to debit rent expense, right, that's going to go to your P&L and credit cash, you're no longer going to do that. You're going to do something a lot more convoluted than that, and you're going to say, okay, day one, you're going to create the obligations. You're going to create a fixed asset called capital leases, right? And you're going to create an obligation, a debt, okay, which is going to be called capital leases as well, okay? And then every month, when you pay the rent, what you're going to do is you're going to say amortization expense, okay, for the proportional share. You're going to amortize it over the lease term, and you're going to have a reserve, right? So allowance, okay, for capital leases. You don't need to know these journal entries, okay? And then what you're going to do is you're going to amortize under the effective interest method your debt. So there's going to be an interest expense, okay, and then your and cash. Okay? So basically, instead of a rent payment, you're going to have amortization expense and interest expense. And over the life of the lease, it's going to be the same. But the difference is that you're going to show on the face of your balance sheet the debt. The obligation that you have is debt. Okay? Yes, Ryan?
To go off Nathan's question about the taxation advantages, can you kind of talk about what's going on with taxing and leases and whether it matters if it's an operating or a finance lease, if you think it's important?
Yeah, I mean, I don't think that's the right question. I'll answer your question, and I'll ask you the right question.
Okay. You can answer that too.
Rent expense is deductible you're a company and you've got rent expense, you're going to be able to deduce it or deduct it. Okay, so it doesn't matter what you do for GAAP. Okay. Under tax law, you've got an expense that's related to the operation of your business. You're going to be able to deduct it. So forget what the accounting rules are. What is common practice? I think I mentioned this last week. What is common practice in small businesses? A technique that's very common is that Ryan owns this company, and then Ryan owns a building, okay? And what Ryan does is Ryan's company leases the building from the subsidiary that Ryan has, right? Now, this is kind of structured in a, LLC, right? So it all flows up to him. So you're going to be able to do depreciation here, which is a non-cash expense. Right? So you're going to generate a bunch of deductions for this guy, okay, which is gonna be tax advantageous, right? And then you're gonna be able to get cash out of the business without having to, and I don't wanna jump, we haven't talked about tax, without having to pay tax there, and then tax when you distribute dividends up to this guy, okay? So this is a way of getting cash out of a business in a tax advantageous format, so that you can probably negate the income tax effect of getting the cash to him, but you're avoiding double taxation of owning the real estate inside a corporate structure.
That's what you were talking about with WeWork?
Well, so the guy at WeWork had a similar structure, but he did it because he was just getting money out. I mean, I don't think he was doing it for tax purposes. He was actually just siphoning cash out of the business, okay? And the problem is, he doesn't own all of WeWorks. He's the CEO that owns a little sliver. There's a bunch of other shareholders, and those shareholders aren't benefiting from that. But I'm just talking about what the tax structuring is in a lot of small businesses in this country is. The real estate will be owned personally and leased by the company from the person. Okay? Yeah? So, from an accounting perspective, all you need to know as far as leases are concerned is that for all practical purposes, as of any annual period that starts after December 15th of last year, whatever lease obligation you have, you're going to have to recognize an asset and a liability. And that liability it's essentially the net present value of your future minimum lease payments. But you're going to have to recognize a liability for your future commitments under those leases. Okay? Now, other concepts that are important. You got to take a look at footnotes. Okay? Footnotes are always going to tell you the terms of these transactions. Okay? They might tell you rates, they might tell you the terms. Now that you're capitalizing them, it's going to tell you how you're amortizing them. But what's important is it's going to tell you if they're related party transactions, such as the one I just explained. So you can have leases between related parties, but you need to disclose the terms of those. So as it relates to leases, always look at the footnotes. I'm going to leave this for the development, and I'm going to talk about another couple of concepts. Leases throw off a series of expenses that tend to be significant to the owner of the real estate. What are they?
Operating.
Taxes. What tax would you generate from a lease?
Oh, from a lease, I'm sorry.
So leases tend to generate 3 or 4. We've talked about all these in class. They tend to generate 3 or 4 significant expenses to the landlord.
An improvement? Yeah. Maybe?
Okay, so TI is one. Commission, so probably the single biggest one are commissions. We've talked about these 4, okay?
Utility.
Those are operating expenses. I'm talking at lease inception.
Marketing, maybe?
That's commissions. I mean, what kind of, the real estate guys put a wooden sign on, yeah, I mean, it's insignificant. I mean, real estate brokers aren't, with all respect, they're not that sophisticated, you know?
Security deposit?
It's not a cost, plus you're getting it if you're the landlord.
Fees.
What kind of fees?
Asset management fees.
You pay those, they're operating, you pay those as you go along. Not on a lease. What costs the landlords incur in conjunction with a lease?
Concession.
So you've got a series, we can call them concessions. Let's talk about a couple of different things in the way of concessions. Let's talk about something called incentives first. Okay? And let's hold that one for 4, okay? Because that free rent is not a cost directly. Okay? What are incentives?
Percentage rent.
Free microwave?
Free microwave.
Oh, you're thinking residential.
Well, I mean, I was just,
Let's think commercial.
well, I'm
No, I'll
just
talk
saying
about
that.
percentage rents in a second, but I'm thinking from the landlord perspective. We're gonna leave free rent, it doesn't cost you anything. You're not paying anything. Okay, so incentives could be, you may have to buy out somebody's lease. Okay, they have a lease that still has another 3 years to go somewhere else. You're gonna assume their lease, so you're gonna have to pay their landlord. Now, you may be able to sublease it, but you're buying that out. What are other incentives? Yes, James?
Limit competition. Competitive limits. Like if you have a sandwich shop, you don't want another sandwich shop.
Well, yeah, so that's definitely going to be so within retail leases in particular, is going to be exclusivity, but the landlord doesn't have to pay for that. But the landlord might have to buy a lease out. What might a landlord do? They might pay for things like, well, we've already got TI. There might be space planning fees, right? They may pay for, you know, an interior designer to lay out space. They may buy furniture for you or give you an allowance to buy furniture, FF&E. What else might they do? They might have to pay for signage. You know, you might get, hey, I want a neon sign on the top of the building, or I want a marquee out front.
Infrastructure? Infrastructure like electricity?
Utilities.
Facilities?
I would, so there might be infrastructure in a park that may need to be done. There might be some exterior. I would probably say anything that's construction related, I would probably consider TI. Okay? But incentives are going to be any out of pocket that you're going to pay to entice a tenant to sign a lease with you.
The security guard?
Those would be operating expenses. You might pay for the move. You might pay for the move. I mean, I haven't seen that one, but you might see that.
How about free rent?
Okay. For the third time. We're going to leave that one for number 4. Somebody said one out there. Well, what? Okay, so if you're paying a tenant to, you're going to subsidize the parking somewhere else. Those are operating expenses going forward. You're not paying that at the time of the lease. Okay, so these are all payments that we got to somehow deal with as landlords at the beginning of a lease term. Okay, now let's just say, so what are let's go. So commissions. We're going to pay the marketing agent a rate. We already talked about last week that in typical leasing transactions, we pay 50% of a lease payment at signing and 50% at its inception. That's typically what we do. So up front, we're out of pocket a lot of money. So we've got to figure out what we're going to do with that. What are TIs? What are tenant improvements?
Renovations.
So those would be any costs that or the cost for accommodating or acclimating or making the space suitable for a particular tenant, right? So, well, so in South Florida today in office, I don't know where we're at. If you're telling me it's 60, I'm probably somewhere between probably 40. Yeah, 40. It depends.
That's what it's for.
And it depends how usable it is afterwards, and it depends. It's all dollars. We're going to have a case study that's going to talk about this soon, okay? But I tell you, 35, 40, maybe $50 a square foot for office might be a normal allowance here, okay? If it's multifamily, what might the allowance be? We talked about this the other day. Painted carpet. Painted carpet, it's a base one. Now, second generation space in office, you might not get $50 a square foot, okay? You might get painted carpet too, okay? You might say, listen, you know what? I'm not knocking down all these partitions. Now, give me a 20-year lease and maybe I'll do that. Give me a 10-year lease and maybe I'll do that, okay? So, but in first generation space, you probably, now what are TIs in industrial?
electricity,
Dollars
um,
in South Florida. What might they be?
I don't know.
15 to 20 bucks? I don't know.
10 to 15, I don't know.
10 to 15? Okay, well, I'll do it a different way. I'll do it a different way. In a 200,000 square foot box, how much office might you have?
Oh,
maybe
1,000 square feet.
12.
How much? Like less than 10%, right? So let's say 5%. So you might have a 10,000 square foot office, right? And what I'm telling you is you're probably going to pay those $40 or $50 a square foot there. So figure it out. You're typically going to pay for the office build out, okay? What might it be in retail? And I'm not a retail person, so if there's a retail person here, they might give me, I'm going to tell you what I think it is.
What, you put some more paint on
When you have to turn it
I
You gotta,
didn't-
yeah, vanilla box.
It also
So-
depends on the type of retail.
Yeah, I think that's number one. I think what you're gonna see in sort of the strip, grocery anchored, community type, you're probably gonna deliver cold space, okay? And you're gonna let, the guy's gonna, do it,
Because we're doing a Golf Galaxy.
okay?
That's, right now we're quoting $75 is the LOI. $75 per foot.
Okay, and so again, getting into a different realm, they'll fixturize the store to their, and a lot of times the retailers will do this, the inside. Are they doing it? Or are you doing it for them?
We're doing it.
Okay. In a lot of cases, retailers will do their own TI, and you'll give them a pretty significant allowance for that, okay? Again, it's all dollars, and we'll do that. We'll figure it out. How much cash are you giving me in income, and how much am I having to pay? So how much is my net present value of this lease? Okay, I'm stream. Typically, you as a landlord want to control the TI because you're going to make sure that permits get pulled. You're going to make sure that stuff is done to code. Okay, and you want to make sure the guy's not pocketing money on the build out. And if there's money to be saved, then you'll get the benefits of it. Okay.
A lot of the new construction guys are asking me to, carry TIs in their hard costs. Why would that be? What was the reason?
Okay. Because typically, and I kind of jumped a little bit. I want to get to a concept called stabilization when we do development costs. Typically, when you look at a new development budget, so a development budget is going to have land, right? It's going to have a whole bunch of sort of soft costs associated, A&E costs, and typically what you're going to carry is first generation TI as part of your development budget, okay? And so that is typically carried in the development budget, okay? But just first generation, okay, and that's it. Okay, so that's why they're probably asking you for that. Now, so incentives, we talked about it's any out of pocket that you're out to incentivize a tenant to come in. And the last one, you all said free rent. Let's call that an abatement, okay? So is that really a cost directly? I mean, are you out of pocket the abatement? You're not paying, you're just not getting. Okay, so yes, it is in fact a cost, okay? These you're paying, this you're just not getting.
You're paying a
You're not
mortgage.
generating,
You're
okay?
paying a mortgage, it's kind of out of your pocket.
Well, yeah, but this you're paying over and above, okay? Okay, so these you're out of pocket, this you're just not getting in your pocket, okay? So yes, there is an opportunity cost, in fact. Somebody's occupying the space and you're not collecting rent, okay? So there are a lot of different rules on how to deal specifically with all these, but as a landlord, all these costs are capitalizable. Okay, and what I mean by capitalizable is you're going to recognize all these as an asset on your balance sheet. So you're going to credit cash and debit some sort of deferred cost. Okay, these are all costs. Why? Because, and we're going to talk about development costs in a second, because we want, one of the basic tenets and principles of accounting is the matching principle. And we try to match revenues
And expenses.
with the pertinent expense. So if I pay commissions today but I don't get my income but for the next 10 years, I'm gonna have what? A huge expense this year and then a bunch of income with no expenses the next year? Doesn't make any sense. So what I wanna do is I wanna group all of my costs associated with that lease, and I am going to amortize those over the lease term. Okay? I want to introduce another concept while we're there, which is something else that real estate operators do, which is, and GAAP requires it, whether it makes sense to you or not, it is what it is. It's the concept of straight lining rents. Has anybody ever heard that? Straight line rents.
Straight line rents.
Straight line rents. Okay. Most rents in this country have some sort of annual step up. Okay, so a bump. Okay. Yeah, I mean 3% is a great proxy. I mean, we always underwrite that. You know, that's pretty common, and that's pretty expected. So it's pretty expected that any rent in this country is going to grow by 3%, or cost of living, which is kind of like 3%, okay? That's going to be common. Now, we also sometimes structure leases which have significantly or different bumps, right? So a tenant comes in and says, I don't want to pay rent this year. I want 12 months free rent. So I've got to find a way to get that rent stream back up to market somehow. So you're likely not going to see 3% bumps after an abatement period. Okay? You're likely going to see, so let's say the market rents are 10. So instead of seeing $10.30 year 2, you're probably going to see like $11. Okay? And then $12. And eventually you're going to get to a point where you're going to get to an inflation. But the idea is to play with, I'll defer collecting cash from you in exchange for you somewhere down the line giving me a market rent. Okay? A lot of times you'll actually see that jump the first year. Because again, I don't want to get into selling techniques, but I buy a building, I want a bunch of tenants in it because I want to be able to sell it with leases in place. I'll forego the cash that first year as long as I can sell it with market rents afterwards. So I'll give you the free year, but I need you at market, the next year. Now, sometimes you're willing to, you're not interested in selling, you might be willing to. So you have these bumps. So what accounting tells you is if year 1 rents are 10, year 2 they're 12, year 3 they're 14, year 3 they're 16, whatever, and so on down the line, you add them, right? I don't know what's the summation of this, 30, 40, 54, 70, is that what that is? Just divide that by 5. And so what you actually do is every year you recognize 1/5 of the rent as revenue, irrespective of how the cash is coming in. And so what that means is the first periods of your lease, you're recognizing more income than the cash you're receiving. And at the latter term, you are recognizing less income than the cash that you're receiving. Because at the end of the lease term, it all washes out. Yes, Brian?
You take the first year that's free also, and you calculate that.
Well, so you do the calculation, right? You sum, right? If you had and remember what I told you guys, if you give somebody an abatement, a good technique is you add that abatement period to the bottom. Oh, you want a 5-year lease with a 1-year abatement period? No worries. We're going to sign a 72-month lease, okay?
Year.
With the first year is the abatement, but I'm going to get 5 years of cash flow from you. So, in a scenario like this, you might see something like that. Okay? And so you add all of the income stream, and for accounting purposes, you divide it by the term, and then every year you take it's like straight line depreciation. You take just a simple average, and that's the income that you recognize. Now, why do you need to know that? Well, we already talked about something called FFO, didn't we? What was FFO, other than a proxy for, net income? And
Fund for operation.
Funds from operations, right? So that's funds from operation. And we said that was like a measure of cash flow, right, for a REE. right? It was kind of like NOI, it was kind of a, but then and so that was basically what? Net income plus depreciation plus gains or losses on sales of assets, right? But then I introduced another concept that was AFFO. Now what was AFFO?
Adjusted fund.
Adjusted funds from operations. And AFFO was what? FFO plus?
Plus,
The most significant component is plus or minus the effect of straight line rents. Okay? Because in FFO, sadly, you still don't really have a true measure of cash flow because REITs report using straight line rents. So you've got to adjust the effect of straight line rents, and then you're also adding back any recurring capex. Okay, that you're investing in a building. So they're two different measures of cash flow. But my point here was that you're adding back straight line rents. And so going back to, it's not only REITs, it's any real estate operator or real estate owner that reports under GAAP. Okay, I'm a private owner. I finance my debt. I have to have an audit. I report to the bank. I've got to straight line my rents. May not make sense, but that's just the way the accounting rules work. Okay. I'm not even going to get, there's another issue here, I'm not even going to get into it because that's other concepts that are important to recognize. Contingent rentals. Because you talked about contingent rentals. What are contingent rentals? What are contingent rentals?
Contingent.
They're the rents that are contingent on something. Okay? We tend to see these typically in retail, and it's going to be percentage rents typically. There is going to be a base rent component, and there's going to be a component associated with the sales volume that the tenant generates. Okay, and so the landlord is going to say, okay, we're going to charge you X, but then we're also going to take 3% or 2% of your sales over and above. Yes?
I was saying, we have that with one of our tenants. Unless they hit an X amount of sales, we get a percentage over that X.
Right. So then there's also thresholds.
Yes. Yeah.
So thresholds the threshold might be binary. If you hit this, we get X. Or it might be if you hit this, we get this percentage over that. Okay? And so that's a landlord saying, hey, your business model assumes $300 a square foot rent. That's right, $300 of revenue per rent. But if we can deliver foot traffic that you do 400, we want a piece over that. Okay? So contingent rents only get recognized when they're collected. When you're the landlord, you only recognize those when you collect them. Obviously, if you are the tenant, you also only recognize them when you achieve the benchmark. Going back to the concept of accrual accounting, okay? So only when you earn them do you recognize it as income. You can't do a model and say, well, I think we're going to earn so much in percentage rents, so we're going to include it in the total and straight line that. Okay? Yes, Armando.
Why would you do that?
Who do that?
Why would a landlord ask for contingent rentals for 4 months?
Well, one, it's business practices because you want to. The concept, I would say, the concept would be to say is, I think I'm going to deliver, some excess returns to you. Okay? You think, your standard store does $300 a square foot of sales, but we're a prime location. There's a lot of foot traffic here. We deliver 400, and I don't want you to make all that money. I mean, I want some of that myself. But it's a standard practice in retail.
So there has to be competition for your space.
There has to be competition, and there has to be perceived value there. Look, I'm not a retail guy, but within the context of retailing, the business model only allows X dollars to go to. We went through how much can a developer ascribe the land in a budget. Well, a retailer could only spend X percentage of his sales dollar in occupancy costs. Okay? And so he's got to generate a certain volume out of a store in order to pay a certain amount. And it's very simple. If you're whatever, K Jewelers or whatever, I don't know. Again, I don't know these, but you can pay so much a Dadeland but you only pay less in Hialeah. Because you're just not gonna sell as much. Maybe sell more, I don't know. Yeah, maybe sell more. But what I'm saying is you may have the same landlord in two different locations, and you're likely gonna pay different rents, because it's ultimately gonna work back to what, and that's one of the measures that you'll see in the case study this week, that one of the measures that retail operators measure is what the dollars per square foot that their tenants are generating. Because that's a measure of success and how much they can push rents to their tenants. Okay? Subleases. What are subleases?
In lease and
Who's you? What is a sublease?
someone who lives and
Providing
and
a
so that-
specified period of time
The
to
tenant?
someone else.
I'm sorry,
tenant
Anthony?
lives.
Providing a specified period of time that you rented this or are leasing the space to someone else also for a specified period of time.
Well, I'll probably jump a little bit more. I'd probably jump a little bit more to Alex. So a traditional lease is a lessor grants a right to use to a lessee. A sublease is when the lessee essentially becomes the lessor, okay, and leases the space. Now, my experience in institutionally owned real estate in this country, this is prohibited by the lease. Why?
Too many.
Well, there's two things. You don't want arbitrage. You don't want this guy leasing from you and making money to this guy. That's number one. Number two, you want a direct contractual relationship with the guy occupying the space. So if the guy's in a breach, you don't want to have to go to this guy to get this guy to correct it. Okay? I have seen at times where this guy will say, subject to approval, I'll let you sublease it, but you can't make any money. So if you make money, you send it back up to me.
Profit.
No, I own a real estate. I own a real estate. You don't want to occupy it, that's great. But you're not the landlord. I'm the landlord. So if you don't want to occupy it and you don't want to be out of pocket, that's fine. You can lease it to somebody else, but you can't make money on that. That's my business. So that's, and if you don't like it, most institutionally owned real estate is going to prohibit subleasing. Yes, Nathan?
You mentioned in one of the, as the incentives, one of the incentives would be to buy out a lease, and then to recover that, some of that buyout, you mentioned subleasing.
Yeah, so, but let's make a distinction between, quote, buying out a lease. So buying out a lease could come in a couple of different ways, okay? I'm the landlord, you're in 3 different buildings and you want to consolidate in a building that I'm building right now, and I want you as a tenant. You say to me, oh, I still have 2 years left there, I got a year here and 3 years there. I'll say to you, I'm gonna make this very easy for you. I'm gonna buy you out of those leases. Now, 2 things can happen. If I can sublease that space, if you contractually can sublease that space, what I'm gonna do is I'm gonna put it on the market, I'm gonna become responsible for those rental payments, and to the extent that there's a deficiency, I'm gonna make it up. To the extent that I cannot sublease it, I'm going to go to those landlords and try to cut a deal and say, hey, this guy's going to leave. I want an early termination. They may say to you, pay me the lease. That's typically what we're going to do. Now, if they think they can make money, right, they'll cut a deal with you and you just write a check. So the lease buyout can be you're paying monthly, or you're making one lump sum payment and getting the guy out. Depending, you're going to find the lowest cost solution for you as a landlord. Okay? Now, let's just say, going back to conservatism, if I by buying stuff out, if I can sublease it, if I'm going to incur a loss, I got to recognize that cost now.
Yeah.
If I'm going to make a profit, I'm only going to recognize that along the way as I do it. Okay, but if I have a known loss, I'm going to recognize it. If it's known and measurable and probable, I'm going to recognize it now. Okay, but you know, I'm going back to that buying out. So buying out a lease can be through a sublease arrangement, or it could be just, directly going to the landlord and doing an early termination on a lease and paying for that. Which may be you may not have a lot of leverage. Most leases don't have, most institutional leases in this country don't have early termination provisions. You may negotiate that. You may know that your business plan isn't going to work, or you're only going to give it X amount of time. There was a restaurant just south of Miracle Mile in Coral Gables called Brick Tops. Same, like Hillstone, Houston, same type concept, okay? Guys out of North Carolina, they had a long-term deal, but they had an early termination clause after 5 years. So after 5 years, they weren't hitting their numbers, and sure enough, like the day of the 5th year, told their employees were out of here in a week, and they shut the place down. So you do have certain situations where you may have that, but for the most part, you occupy space, institutional guys are going to say, we'll give it to you, we'll spend the TI, we'll pay the commissions, but you're in it. Sean?
I was just going to say that you could do an assignment instead of a sublease, right? Where it takes the tenant out and then they assign it to the tenant.
Again,
the landlord approves of it.
You're going to have to negotiate that up front, and any assignment that exists is always, it's always going to be at the sole and exclusive right of the landlord. Because what the landlord doesn't want, I'm the landlord. Marina comes to me, I can do a credit check on her. I know who she is and I know her ability to pay. Now she assigns a lease to you. I don't know your credit. So if I'm going to give her the right to assign the lease, I'm going to reserve the right to approve that. And you typically are not going to see.
But you can do that instead of a sublease. So then the person that...
Well, who is you?
You as the landlord. So then the person that...
I'm not going to sign that lease. I'm going to negotiate and I'm going to enter into a lease with you. I mean, I'm not telling you that you legally can't assign a lease. You can assign a lease, can't you, John?
Yes.
But you don't...
We've done lease assignments a few times.
Okay.
So I'm just saying it's a different way to do it than subleasing.
Okay. And what type of deals have they been?
Just industrial space leases.
What size?
So 3,500 square feet.
Okay, non-institutional grade stuff.
No, somebody wanted to leave, so we said go find a credit-worthy tenant, and we'll let you leave and assign the lease to them.
Okay. Why wouldn't you just have done a new lease?
I don't know. We just decided to do it.
Are you a broker?
No.
Because if you're a broker, you definitely want to do a new lease. Why? Because you want a commission, right? If you're an owner, I don't know. Yeah, I mean, I don't know. Without being an attorney, I would just say, okay, find me a tenant and I'll let you out, but I want to sign a lease. It might be the same exact lease, but I want to sign a lease with you. I don't know if contractually an assignment is identical or not. I don't know. John? But
Similar, yes.
very similar. So I would be in a worse position as a landlord if a lease has been assigned?
No, not the worst position.
Okay, all right, so I guess that's the thing. I haven't seen it with institutional real estate, okay? And typically, I might let somebody out if they bring me a tenant that I approve of, but I would just do a new lease.
When someone sells a business and you have a lease with someone, we've done this in the past where the person sold their business, the lease was part of the business, and then we went into an agreement with the new person.
But you signed a new lease with that person?
Yes.
Yeah, yeah. That's what I would do, and it may be under the same conditions, maybe better conditions, but that's what I've seen. But it's good to know you can assign.
Assigning it is just skipping a step. Instead of terminating the lease and doing a new lease, you just assign it. The terms are good.
Just the other couple of things, renewals and extensions are you need to view from an accounting perspective as new transactions. So whatever, an extension might have commissions associated with it. It might have more TI. Okay, so you got to look at it as a new financial transaction. Okay, and then the other thing from an accounting perspective, and I'm not going to get into a lot of detail. We'll take a break for 8 minutes. Is Hey, yeah, we got it. You ask questions. I talk too much and then you pay the price.
That's not a good contract.
We talked about CAM last week, but there are tenant reimbursements. Wow, Jack got upset at something. No, he
He's taking it too.
Assignments. No, CAM, we talked about common area maintenance. We talked about expenses that tenants paid for the space outside their space. As it relates to CAM and as it relates to reimbursements on triple net type leases, or any excess payments over a base rent that are due, are annual adjustments typically that are made between landlords and tenants. And I just caution that you need to keep good records and you need to have good communication with tenants, or landlords need to have good communication with tenants, or tenants need to have good communication with landlord. And there's an accounting concept, a problem related to both, is that what do I do if I get an invoice in February for the previous year and I didn't account for that? So as a landlord, you need to make sure that you are accruing some sort of receivable for that CAM or that reimbursement. And as a tenant, you also need to be accruing an expense for what you're going to be billed, because that tends to be done after the fact. Okay, and so I know that with our Flagler subsidiary, what we used to do is a rather sizable portfolio. In most of our leases, we actually just did quarterly invoicing to our tenants, and then even within every month, we would do an internal estimate. So that way the tenants weren't shocked at the end of the year when a big invoice came, and we also were neither under-recognizing or over-recognizing an income or an expense. Okay, so that's it. Let's be back in 6 minutes.
That was 8.
Yeah, I know, but I talk too much.
Did you get the corner for
Give me one second. I just give me one second.
okay.
You need a water or anything?
I've got, thank you.
Okay. Dr. Forky utilizes Amazon Prime Pantry. We got a communication in there.
Crap. Okay, I'm sorry. So what is your question?
Yeah, so what is,
So the 10-year treasury is very simple. Is the government needs, so the government spends more than what it makes.
Okay, no.
It collects taxes and it spends more. That's just a fact. So it can print money. It can just increase taxes, or it can borrow money.
Yeah.
In practicality, the one it does the most of is borrowing money. There's a cost to that. So it borrows money in different terms. It borrows money for 30 days, for 60 days, for 90 days.
No, that's not.
It also borrows money for 10 years.
I don't know what the forwards are.
The 10-year treasury is the cost of the borrowings that the government
That's
has
what
for
we
10
measure.
years.
Leases.
It issues a bond for 10 years. So it says in 10 years, I'm going to pay you so much, and this is how much interest you're going to earn. That's all it is.
No, it was after
The interest
that.
to the guy that they're borrowing from.
The guy that buys the bond.
And who they borrowing from most of the time?
It's primarily institutional. So banks, insurance companies, pension funds.
I just don't think I have the date.
Most of it is domestic, but you know, you probably read the Chinese government has like 2 billion has like 10% of it. So yeah, externally too, but primarily, I think like 60% is domestically owned. Okay, and that's all institutional. Let me call my parent.
Four rules of leasing under FAS.
Well, they make a living by so like
Yeah, it's
when
about 4 rules.
when the question,
Yeah, and actually, Mark gonna be, yeah.
I can't tell. Yeah, it's one. Because I thought he was going into it.
when I said, we said, where would you park money? A lot of people will, especially as you get older, well, treasuries of some maturity, a very common technique is people do what's called a ladder. They'll buy one, so much 1 year, so much 2 years, so much 3 years. So that every year, a certain amount, and then once it renews, so when it expires, it matures, they just reinvest at the end of the ladder. So that's a common thing that people do. Yeah, and older people buy treasuries. And a lot more bonds and stock. John, you had a question? Or,
The 4 rules of leasing under FAS.
no, okay. No, so FAS 13, so the 4 rules related to distinguishing whether a lease was a capital or an operating lease were, is there a bargain option? Bargain purchase option?
It's hard to get around, no cars, you walk everywhere, ride a boat.
Is there a transfer title? Does the lease term exceed 75% of the economic life of the asset?
75%?
75% of the economic life of the asset? And then the last one is, does the net present value of the future minimum lease payments exceed 90% of the value of the asset? And you don't need to know those things, but what those things are talking
You're supposed to tell
to,
me that before I scribble.
well, but you don't need to know that anymore. I used to ask those kind of things, but what all those things talk to is this really like just a financing arrangement?
Right.
Or not? Because if there's a purchase, if there's a transfer title or a bargain purchase, it's just like financing. You know, you go to get a copier. You can buy it out at the end of a year. It's not really a lease. Does it exceed? Are you taking it for the bulk of its life? So these were just trying to point to things that would say, hey, you know what? Yeah, you structured it as a lease, but this is really a purchase with a financing associated with it. So we're going to ask you to book it as an asset and as a liability.
Gotcha.
Just as if you had gone to the bank and borrowed the money to do it.
Gotcha. Thank you.
Is Ben back yet or not yet?
That's right.
Ben, is he back
From
yet?
Zed.
No, he's one more week.
I looked at the reason
He's
for
over in, I think, Greece.
nothing. I think it was Dave and Junior just
Yeah.
donating. And nothing came to us. It was no redevelopment of anything. So, I mean, we can go with that. We can go to Galleria. I really like Galleria. Yeah, because she already paid for it.
Party there when he was
Right, but I didn't know if he got anything. Found it.
It's like general questions. There are specific articles.
Oh, you just heard the controversy. Right.
Let's do Black Friday. Black Friday is that whole
They all end up being the same now.
And I just like short for making, sorry.
Reading that 5 days ago.
Their investor did one.
I got one wrong, like, oh.
First time I went to get this, we were saying,
None of these are mine, but I had it was considered homeschool.
like some of those, they still have murals.
I love home.
I would drop it out.
So when you go, no, sorry, it's just past the but you can go and you pay, and you pay the guard and you go in, and that's all they show.
Thursday at 3.
No, but that's the campus there. You talk about the car.
Oceanography, yeah, but I mean, you're literally looking at from right about here, all the way through here, to go from here all the way through is beach, and you can walk, you can literally walk all the way down. Except not to right. No, that's beach. Like, half of that's just sand.
Okay.
The bottom looks fine.
All right, we're back. We're back.
But I prefer it over football.
Last. So, sorry. So the summary of all that long explanation is leases for the most part have to be capitalized. You have to recognize an asset and a liability as if you had purchased the asset and borrowed the money. And the other concept we talked about, all these costs that are incurred by a landlord related to a lease, commissions, tenant improvements, abatement, well, abatement which is not a cost, but we need to capitalize all these and amortize them over the lease term. Okay? And then the lease stream is recognized on a straight line basis. Yeah? Make sense? That's the long and the short of it. That's what you need to know. I'm going to do another short or brief one related to sales of real estate. And when we talk about sales of real estate, the real issue here is revenue recognition. Revenue recognition. Do we have a sale? And if we have a sale, how much income do we recognize? Now, we're in a transition period. We had a FASB 66 that was issued in '82 that gave us guidance on this, but there was a new pronouncement on revenue recognition in general. Okay, in general, that was issued a couple of years ago, and I'm looking for it here. And so it's kind of changed things, and the reality is that they needed to be changed. FASB 82 was promulgated. FASB 66 was promulgated in 1982, and there were certain things happening in the sales of real estate that really aren't the case anymore for a variety of reasons. But the most significant one of which was that there was a tremendous amount of seller financing being provided in real estate transactions. What's seller financing?
When the seller is
Seller's
financing
acting
it
as
to
a bank.
When the seller is financing something, okay? You got an act for the obvious. Okay, you've heard taking paper back.
You hold the title, right?
Well, you don't hold the title, you hold the security interest in the property. So basically you become the
Mortgagee broker.
hold on, mortgagee, okay? So you sell a piece of land for 100, you collect 20 and hold a mortgage for 80. And then the buyer pays you over time. That used to be very prominent in this country, okay?
I think we should do that.
Sorry?
I think we should do that.
Well, if you're saying a lot of people, I haven't seen a lot of it, and I thought like when 2008 came around, we would see a lot of it because there weren't credit markets, and I really, in large transactions, haven't seen a lot of it. But the question that it beckons is, if I sell you a piece of land for 100 and you give me 5, I may have met a legal sale. So I may have had a closing, right? I may have delivered title, but have I collected it? And what's the likelihood that I'm going to collect it? And, well, depending on who, right? And so there are a whole bunch of rules on, is there a sale? And if there is a sale, then the question becomes, how much profit do I recognize? And under what method do I recognize it, okay? And so there used to be a series of thresholds that ultimately talked to how much at risk the buyer was. And there were presumptions that, for example, if somebody bought a piece of land, and they put 30% down, that they were sufficiently invested in that land that they were going to try to, you know, make the payments, right? So in that case, you would probably be able to fully recognize the profit. Now, you know, looked at a different way, if somebody paid a 5% deposit, they probably weren't enough at risk that if the market went south, that they would continue to pay. And so maybe you would use like an installment, what was called the installment method of profit recognition or deposit. We'll talk about a couple of different cases where that was the case with companies that operated here in Florida. Okay, but the real question was: is there a sale? Is there a sale? And what's the likelihood that I'm going to recognize my profit? Right. There was another issue related to, and then this one continues to exist, related to real estate, which is what we talk to continuing involvement. A lot of times a developer sells you something. You bought something from Lennar, right? In Doral, right? Did they have to do like a community house or something, or a pool or anything like that? Infrastructure, all the roads built out?
Yeah.
Okay, so you bought one in which the developer already put all the infrastructure in. But there's a lot of times where you're like the first buyer in a huge development, you know, amenities like like golf courses haven't been built, And so the question becomes, if I recognize all my profit now, when do I recognize the costs associated with all of these other things? Okay, and so the question became, is it a sale? Is it not a sale? And if it is a sale, how much profit do I recognize now? So I'm not going to waste a lot of time in going through. I could just tell you that at this point, there's a new FASB out there, or not FASB, but a new pronouncement issued at the beginning of last year. And they talk, you don't have to learn, I'm not going to ask you these things at the end of the class, so you just hear them out, okay? You need to identify the contract. Does the contract exist? Is there seller financing or not? Is there any future obligation, right? Identify the performance obligations. Make sure that you account for those, okay? Determine what the transaction price is. Is it fixed? Does it have contingencies associated with it? Allocate it, okay? If there's different revenue pieces or different contracts. And again, in real estate it may be easier. Maybe you're buying hardware and software together. You have to allocate the purchase price, because this is a generic pronouncement on revenue recognition. And then you can start recognizing the revenue as the seller performs all his obligations, and as the buyer, performs all his obligations. Okay, so you don't need to know that, but what you do need to know is that when you sell something, somebody in your accounting department or an auditor is going to ask the question: have all the obligations been fulfilled? Is collectability reasonably assured? Okay, have promises been exchanged? And based on that, they're going to recognize more or less. There's going to be an evolution as it relates to real estate on guidance on this. So I don't want to spend a lot of time, because this is coming out now, we're in a transition period, okay? Just know that if, it's very simple. If you sell and you have no further obligation and you collect all cash, you're gonna recognize all your profit. If you sell and you haven't collected all your cash and you still have some continuing obligation, you may not be able to recognize a sale, or you may not be able to recognize all of your profit. And that's all you need to know. Yeah? I want to just give you a couple of other tidbits in this particular area on companies that are unique to Florida, or in certain cases partially unique to Florida, that you may come across or may have come across in the past. The first one is the timeshare industry. Now, I got an article here from Florida Trend last year, and it said that, again, this is from Florida Trend, so I don't, but it said that the timeshare industry generates essentially $15 billion a year, bless you, in economic impact to the state of Florida. Now, we don't see that much of it here in South Florida, but where do we see a lot of it?
Orlando.
In Orlando, in Central Florida, right? Some in the Keys. I think there's some stuff down in you know, and it tells you about, you know, who buys and all that kind of thing. It doesn't really matter, but it says Orlando, the Orlando market's nearly 90% of the properties in the state. There's roughly 30,000 units, timeshare units in Orlando, and about 45,000 workers. Now, just concepts that you should know, and again, I'm not an attorney. There's a lot of sort of bad vibes surrounding timeshares, and in fact, I kind of lived one of these in the last week, related to my parents, but there's different ownership titles that exist, and they're all kind of bizarre. So the first one is that you've got ownership structures with deeds, and probably the most common one is what's called interval ownership. And interval ownership is where you own a particular week in a particular unit. Okay, and so in that sense, like, I've got, you know, the week from the 18th week of the year in unit 48, and that's the one that I buy. So I have a deed for that, okay? There are transactions in which you get a deed, but you have an undivided interest, so you're a tenant in common, okay? So you're going to be a tenant in common with 52 other people, or 50 other people, in a particular unit, or in a particular property. And so based on that, you know, you're going to have rights for, you know, use based on how many other tenants in commons there are, and how you manage to operate, or how you agree to operate that. And then the other one is what's called floating time. And so again, it's a deed, and floating time is kind of like, you probably heard, kind of like points. Like you buy X amount of floating time, and so maybe you've got 10,000 points, and that might be worth, if it's in a ski area, it might be worth 2 weeks in the summer, or 4 days in prime ski, you know, season. Or if it's in, you know, I don't know, in Orlando, I guess Orlando's hot in the summer. I mean, hot like in the sense like you can take your kids and stuff, so maybe you only get 1 week in the summer, but if you take it in the winter, you get more. So you can get your interval ownership, which is 1 unit, 1 week, right? You can have your undivided interest, or you can have floating time. So those are deed structures, okay?
So you're saying floating times are just like unknown dates when...
Right, so you have rights to a certain amount of use, and then there's always a management company, right? Sometimes a lot of times a developer sticks around and has a management business. So they'll sell essentially X number of points available out there, and then based on the points I'm calling them points, you know, they might call them vouchers or dollars or whatever, but you're going to be entitled, depending on the time of the year, to book a certain amount of time, and so you'll be able to exchange whatever value you bought, whatever value you have with your deed, for a specific use, depending on the time of year that it is. Okay, does that make sense? Now there's other arrangements. So you've got deeds, you've got right to use agreements. And right to use agreements are very similar to leases. My parents are getting out of they're having a lease, a right to use agreement terminated. they've owned a timeshare down in Aruba for like 20 years, and it just, I mean, my dad's 88 and ill, and my mom's 83, and they can't go down there, so there's, but it's basically, it's like a lease. It's a right to use for a fixed period of time. In their particular case, it's for 50 years. It could be negotiated, but like in their particular case, it doesn't. And I'm going to talk about liquidity on these things in a second. There's really no liquidity. In their contract, they can only essentially put it back to the operator. So the operator sets a price, and right now he says the price is 0. So basically, the only thing you can do is give them the unit back, and they'll sell it to somebody else. But so a right to use is like a lease, okay? And then there's hybrid deals where they you know, there's kind of like, they might be part lease, part deed. I'm not a lawyer, there's not a legal class. But what I want to talk to is that, I don't know if you hear, there's a bunch of lawyers out there now trying to help people break, you know, these arrangements.
Yeah, I hear it on the radio.
You hear that on the radio a lot. It's because there's a lot, there's really funky ownership structures that people are not comfortable or used to dealing with. And the worst part is there's very limited liquidity in these things. Right? So a lot of times you get into it because it seems like low money. Hey, put $5,000 now, but then every year you're putting in $1,500. And then there's special assessments that come along the way. And usually the operator stays behind this, okay? So just a couple of issues. If you are a developer of timeshare, some of the problems that you're going to run into might be in recognizing profits is adequacy of down payment, right? And typically a lot of times it's continuing obligations, especially if it's early on, you know? You start selling it and somewhere down the line you're going to deliver a golf course or a pool or a clubhouse, but you're not there yet. So you're getting all this money, but can you really recognize profit right now when you still haven't delivered everything that you need to deliver? Okay, so revenue recognition is an issue as it relates to timeshare operators. The only other thing I want to make you aware of, there is a limited level of liquidity with these, and I say liquidity, so it's not like a stock market where, you know, there's a timeshare buy-sell exchange. You know, a lot of times, some contracts give you the right to sell them or to assign them. But then you either got to find a broker that does it, or you got to put an ad. A lot of times people will try to reach out to other people so that, you know, you buy an extra week, or you buy the week before, the week after, so you get two. But the real liquidity that the industry developed, there are two players out there. There's a company called RCI, and there's a company called Interval International, which is based here in Miami. And what these guys are is it's essentially a timeshare exchange. And so what they will do is a timeshare developer will enter into an agreement with either of these two companies. And I say either or two of them. RCI is like 90% of the market, okay? Interval is large, but it's significantly smaller. So they will develop the timeshare project and put it into this timeshare pool. And what that gives is the owners of the deeds, or the participants in these right-to-use agreements, the ability to put their units or their time into this exchange and swap it. So you may have a ski resort in Park City, but you can swap it for, you know, a week in Orlando, or, you know, a house in, you know, Ibiza or whatever, okay? You know, but that's a business too, so you gotta own, I mean, you gotta become a member in Interval or RCI, you gotta pay a fee, and then there's a fee for exchanging, and not all things have a value. So it's not that easy. It's not that easy, but there is some liquidity available, and the liquidity is only in the ability to use it in something else. Okay, they don't buy and sell from you, okay? Typically what will happen is if you don't want to use it, if they're able to lease it, you might get something out of it, but I think typically you don't get anything out of it. They just, you know, they just sort of suck it up. Okay? And then the other exchange that you have is if you're a member of these, you typically have an ability to buy time at any one of their properties from people that aren't going to use it at some sort of, you know, favorable rate. Okay, I mean, does that sound familiar to any of you guys, or? Yeah, I mean, some people may come across it, some people may not have come across it, but it is a big industry here in Florida. Yes, sir.
Is there any tax benefits to owning a timeshare?
I wouldn't think so. I mean, I wouldn't think so. I mean, I don't, no. I mean, I don't think that you could own it as or an investment or anything like that, so.
What's the demographics?
I'll tell you, it's interesting you ask, because I wouldn't have known other than this article actually has some of that. And it talks to the demographics of the people that buy them here in Florida, okay? And the source of this is the American Resort Development Association. Okay, 60% are white, 20% are African American, 14% are Asian American. The average age is 47. 61% are employed full-time, 68% are married, 44% have kids, 84% of them own their own home. The average median household, and this from a couple of years ago, was $81,000. 47% spent less than $10,000 on their timeshare. 26% paid between 10 and 20, and essentially 30% spent more than 20,000. So I mean, it seems like a older, more affluent group of people, and it looks like people who own their house but don't want to, either don't or don't have enough money to afford. They can't buy a second home. Bless you. They aspire to have a second home, but they either can't or don't want to own a second home.
Are people buying more timeshares, or are they buying less?
I don't know if they're buying any more or less.
I think it's going down.
I think the thing is that they're very geographically focused, and so I think if you went to Orlando and drove around all the time, you'd probably see a lot of them. Or if you go to Aruba or whatever, or Key West, you probably see a lot of them. But if you drive through Miami, the economics don't work. You know, you can't.
There's two in Miami Beach.
Are there?
But there's, you know, they're not. We're very.
I mean,
well
there was Marriott had one in Doral. Part of
that's right.
part of where you live, it's still there. Okay, but they had some excess. But Marriott had some excess land next to it where they were going to develop more, and they never did. And part of your development used to be excess land that Marriott had there.
They're into an apartment building. That lease that Marriott sold it to a random developer.
I think with things
So
like
the random guy that I was involved in, so that's why I know.
I think with things like Airbnb coming out, why would you buy a timeshare in Orlando?
Yeah, listen.
Aruba makes sense.
Yeah.
Businesses change well, and Aruba may not make sense if they are amenable to Airbnb ownership rights.
Right.
If they restrict them, like maybe in Miami Beach, it looks like there's a big push towards restricting them, and other communities, then maybe not. But there's that goes back to why you have to read the newspaper, James, which you didn't run to, because here you wanted to be a timeshare developer, and you just realize that there's no business there because Airbnb is in. No, but that's why you have to, follow trends that are going on. That's a good point. I don't know. I mean, it seems to me that there are fewer timeshares than when I was a kid, but I also don't pay attention to all the junk mail stuff. I mean, they used to be heavy-duty junk mail producers. You get all this stuff, or you get before the 800 no-call registry or whatever. You could get called all the time to go on a free cruise, and they would sell you a timeshare in Freeport or something like that, So, anyway, the other sort of unique thing that I wanted to talk to you about was retail land sale companies. Does anybody know what those are? Retail land sales. No, that's so you're talking more about like triple net lease type, but no. So it has nothing to do with retail use. So you should know, because these really almost don't exist anymore, but it's really how Florida was built. So Florida really was built by people like the Mackel brothers. Mackel brothers, ring a bell to you? Deltona? Well, okay, so Henry Flagler put the railroad, yes, but sadly, from 1898, the railroad opened to really into the 40s and 50s. A lot of people didn't live in Florida, and the few people that were bringing people down to Florida were companies like Deltona, which were the Macro Brothers, General Development, GDC, does that ring a bell? General Acceptance. Some of that exists now. It's something called Avatar. Lehigh Acres. Lehigh Acres. Anybody ever flown from Tampa to Miami? No.
Yeah.
Has anybody ever flown over Fort Myers?
Yeah.
And you look down and you see like this like what seems like hundreds of miles of like just roads of grid. So retail land companies were people that would buy huge tracts of land, okay, and they would build out the infrastructure. So they put all these roads, right, and clubhouses and stuff, and then they would sell these like little 6,000 square foot parcels. And they would sell the American dream to everybody. So there'd be these big boiler room operations. It'd be like hundreds of people in a room. And it'd be like the middle of February, and they'd be calling people in New York saying, don't you want a piece of the pie here in Florida, you know? And it'd be all this direct mail where they would be basically selling. So what they were selling were little quick claim deeds on little parcels.
So like Glenn Gary, Glenn Ross?
It's exactly like that movie. That's what that movie was. I forgot that movie. That's exactly. It's a horrible movie, by the way. It's very depressing.
Yeah.
I don't remember much about it, but it was very because there were salesmen that worked in these sort of like boiler room environments, selling these retail land parcels, and you're like saying, "Ooh." I mean, I can tell you when I got out of college, they were still big. I did work at a remnants, what was left of Deltona, of the Macro Brothers. Key Biscayne was developed by Macro. Very similar, okay? GDC, so you know, who knows where Monty's is in Coconut Grove? There's a big tower across the street. Big office building that Manny Medina, that Terramark built. That was the GDC tower. General Development occupied 80% of that building. That went bankrupt in 86, 87, something like that. Avatar still have a base in GAC on Alhambra and Coral Gables. And Lehigh Acres was part of Lehigh Acres was a big chunk of, I forget the name of the big Phoenix-based SNL that went bankrupt in the late 80s. And I did work at Lehigh Acres as well. I did part of the audit work out there. But it was very, very typical way that people bought real estate in Florida. And probably from the 20s all the way up until the late 80s, they were prevalent. And so these were just interesting that these people, they sold you quick claim, they would deliver a quick claim deed, but it was saying pay $500, pay really low down payments, pay $500, pay $50 a month for the next 30 years. And so, no adequacy of down payment, continuing involvement, uncertainty in collection. So typically you couldn't recognize profit, okay? So, as a developer, you couldn't recognize profit, or you had issues recognizing profit. But I thought it was an interesting, way in which really, and I always like it because it's history, it's Florida history, and people don't, you gotta know where you came from. And the one thing that I can tell you in real estate is things come back. You guys used the Brueggemann book in like real estate finance or real estate investments. There's a section in there, for example, that deals with participating loans. And I think, does Dr. Forgy still do participating loans or no? He does? He talks about it. Okay. I haven't seen a participating loan. I hadn't seen a participating loan in 20 years. And all of a sudden I saw one like 6 months ago. So stuff always comes back around. So you think things that are, like new and innovative, a lot of times people just go back and borrow stuff from the past. So in the 1980s, participating mortgages and loans were very, very prevalent and common. Seller financing was common. Tax law may change, and all of a sudden we restrict 1031s, and maybe taking paper back on a sale is a more tax-efficient way of staying involved in real estate. You book your profit, and that's what happened. 1031 rules got very relaxed, and we started getting a lot of sort of disintermediation in the credit market. So a lot more variety came into the credit markets in real estate, and so people started financing land. You really saw in the 1980s banks started doing joint ventures and participating loan agreements. So all of a sudden seller financing disappeared because there were tax efficient ways of reinvesting real estate. You sold, and you went from an equity interest to a debt interest, and you could recognize your profit on an installment basis. So you could recognize your profit over the 20 years of the mortgage that you had. Or there were alternative markets that provided capital into the industry, and so you didn't have to take paper back in order to sell. Somebody else was willing to do that, okay? So, but you never know. There might be changes in the tax law, there might be, you know, constricting of the capital markets, and maybe seller financing comes back and becomes an issue. So I just, you know, just share knowledge and share information. So anyway, real estate sales, revenue recognition is the concern as it relates to sales of real estate. Do we really have a sale? Have I conveyed all the rights and obligations? Have I performed everything that I need to perform? Okay, so the question then becomes, can I recognize profit? And if I can, how much can I recognize? That's all you need to, okay? There is a nuance. I'm not going to go into it. I am going to go into it because I think it's important. I am going to go into it. There is a nuance. And I wonder how this is all going to play out as this new pronouncement, you know, gets evaluated. Developers of condominiums have the ability to recognize profit on a percentage of completion basis, even though they've not completed the project. So the accounting guideline allows you to recognize profit on a percentage of completion basis. That's very common in construction. But the difference in construction is in construction you've got GC and you have client. And every month the client is paying the GC. Now, he may be borrowing the money, but he's on the hook for it. Okay, so this guy is collecting money from the client who is not risk. So the construction company can estimate what their total profits are going to be. So construction companies recognize revenue on a percentage of completion basis, and what they typically use as a proration is cost to date over estimated total project costs. Okay, so I'm 80% of my cost, I can recognize 80% of my anticipated profit. But I now have a buyer that's on the hook. When you've got a condominium, you've got a developer, and you've got buyers over here. These buyers are not at risk yet. They may have paid a deposit, but the bulk of this financing is coming from a bank that who is obliged to? The buyer of the unit or the developer? The developer. Okay, and so, I mean, I've always had a personal issue, and I'll talk in a second about an experience that I had. The accounting guidelines allow you to use the same formulation of percentage recognition of profit as long as you meet certain hurdles. You know, these people have to be contractually bound, all the units or a majority of the units have to be sold so that you know you're going to go through. But you still, the problem is there's no certainty of closing because this guy's not at risk. You're at risk because you're the ones who borrowed the money, not the ultimate buyer. Okay? And so, but the accounting rules do permit recognition of profit on a percentage of completion basis. I don't know where that's all going to wind up. I did a deal, when I was doing due diligence work, I did a deal down in Mexico City in which a Pulte Homes is going to buy a developer of I'm trying to remember the exact word they used. So it was neither workforce housing or affordable housing. It was what they called vivienda social. And in Latin America, Brazil is an issue. You're Brazilian, yeah? Social housing is slightly Peru, Mexico. So affordable housing takes a totally different context there. Because that's even, you know, these people were building homes in Mexico City that were 250 square feet. So I mean, you were really taking people from the informal home sector for the first time into a formalized home environment. So there's people coming out of shanties, you know, squatters. We talk about all these things. People coming from squatting into a formalized environment or a deed. So anyway, Pulte was going to buy these guys, and these guys had recognized something like, so Pulte had entered into a contract to purchase this company for $200 million. And they were building 6 or 7 of these projects in Mexico City, they were using Arthur Anderson as a time as their auditors. This was a few months before Anderson went bankrupt. And so this guy was using, I remember going to the Anderson offices, and the partner said to me, "Oh, the most beautiful office I've ever been in my life. And Las Lomas, people serving you with white gloves. I mean, it was spectacular." Okay? And I said, so, you know, talk to me. So they said, "Look, we've recognized on a percentage of completion basis profit on these 6 or 7 buildings that they were building." They hadn't sold one unit. They didn't have one customer. And so the rationale was that all these customers, when it comes, there was these things called, I think they were called, is there anybody who's Mexican here? I think they were called afores, which are, I know in Brazil there's a similar structure where part of your social security contribution goes into a fund that provides mortgages for this type housing. Okay, so the entity in Mexico that governed this, they said, well, they're essentially going to guarantee us there's plenty of people coming out of this informal housing that when we finish, we'll buy these. So these guys financed, you know, they had third-party people, including J.P. Morgan, a J.P. Morgan fund, that financed all this construction, and they were booking all this profit. They never sold a unit. That wasn't completed. So, you know, we alerted Pulte to this. So Pulte was like, well, I thought they delivered all these units and all. Eventually, they pulled the contract, and this company ultimately went bankrupt. Because why? They finished all the units, and there were no buyers. But you looked at the financial statements, and they were making all this profit. Because they were building, they were, you know, 40% complete, 50% complete. Every month, they were making profits. But they weren't collecting anything from the guy that was going to buy. And when the time came for them to close, there was no buyer. Or no qualified buyer that had the ability to close on those units at the price that they were stipulating. So, all these rules matter. So when you look at financial statements, oh, wow, what a profitable home builder. Wow, it's Pulte. Wow. I mean, so this is, I don't know, 2000, 1999, 2000, something like that. Wow. You know, NAFTA was still relatively young. I know we don't have NAFTA anymore. I don't know what it's called, but, you know, wow, we want to get into Mexico. Wow, this sounds like a, wow, it's all these young, aggressive guys, U.S. educated. Be careful when you go. I don't want to beat up Mexico or Mexicans, okay? Be careful. Be careful when you do business outside a jurisdiction in which you have intimate business knowledge. I can tell you, I personally have been in a notary in Mexico City, watching when a notary notarized a mortgage that 2 months later didn't exist. It disappeared. There was no record of it. How can that be? Well, it's Mexico. I mean, obviously somebody paid the guy enough. Somebody paid the guy enough to make him forget that it ever existed or that he ever notarized. And if you understand, in countries with the Napoleonic Code, the notary is a safeguard of the public trust, of public faith. There's no public registry of property. The notary keeps that. So if there's no mortgage at the notary, there's no mortgage. I'm telling you, and I was there. And I was there. I was there. So, but you have to be careful so be careful what documents say, but also understand. One of the issues that we have with China, we haven't talked about China, one of the issues we have with China is what? So we've got, but the big concern is if they agree to comply with all these intellectual property theft rights and all that, what rule of law or what legal structure is going to guarantee, right, the enforcement? The UN. Okay, so anyway, I'm going to jump to, I'm going to leave, I was going to do development costs, which is probably the most important one. So leases, you got some concepts, right? Just to summarize, you got to recognize it as an asset and as a debt. There's certain costs associated with acquiring a lease. You got to capitalize those and amortize them over a lease term. Sales of real estate deal with revenue recognition. Do we have a sale? When we have a sale, how much profit do we recognize? Do we have continuing involvement? We talked about some, unique nuances. development costs are probably more relevant, just because we incur a lot of costs. But that's a longer presentation, and I want to go over the case study, and I want to prepare you for the next case study. So I'm going to leave that in taxation, which I was hoping to all accomplish today, for next week. And I want to go over the case study. Just want to go over the case study.
When you say development costs, in what sense? Can you just give us a little piece of it?
Yeah. No, it's a concept of how, so it really goes back to matching. And so as accountants, we want to match revenues with the pertinent costs. And so the developments have a long life associated with them. We talked about this. I mean, you know, an office development easily takes 3 years to not say 5, okay? An industrial box, probably a little bit easier. Easily it'll take 18 to 24 months to not say 3 years, depending on, and so it doesn't make sense to be incurring a bunch of costs and recognizing expenses for 2 years or 3 years, and then when you sell it, all of a sudden you've got all this income and no expense. So we need to find a way in which we can accumulate costs so that when we recognize the revenue associated with that cost, we can properly match those expenses with the cost. Okay. And so we've got a series of rules that are going to tell us, depending on the cost, what do we do with it? Do we defer it to a future period to match it with the revenues? Or do we recognize them currently? So, is it really an expense, or is it an asset?
Okay.
Does that give you the flavor?
Yeah.
I mean, I feel like I want to keep going with this because I really like this, but let's go to the case study. So, not all of you did it, which is okay. I wouldn't say it was like the hardest case study, but there are things I'd like to say, whether you did it or not. I jotted some notes down as I reviewed them that I wanted to share. If I could read my notes, it would be helpful. Okay. So, let me just give you some generic. If the shoe fits, wear it. Okay. If it doesn't fit, then don't wear it. But so, oh, I didn't do that. That doesn't matter. Some of you did, some of you didn't. But just tools, techniques, ideas, suggestions. The first one I already said, ask questions. I'm going to equate this particular case study to an RFP that somebody puts out to a developer. Guy puts out a bunch of, sort of requirements, right? So if there's a doubt as to how you should answer, pick up the phone and call them and ask for clarification. So I'm not sure, what would you like to see? Because the worst thing that you want to do is respond to an RFP and get the answer wrong, right? And be disqualified, not because you're not competent, but because you just didn't qualify yourself by giving the right answer or the right structure. So, on that, submit things that are easy to read. Your thinking may not be your client's thinking, but what's the golden rule? What's the golden rule?
Client's always right.
Do unto others. This is the real golden rule. Do unto others as you would have them do unto you. What's the San Miguel golden rule? He who has the gold rules. He who has the gold rules. Your client rules. So you may not. I got a very nice submission that grouped some of my questions together, and in their way grouped concepts. That's great, but I can't grade that. Forget grading. If I were evaluating a submission to an RFP, I've always responded, I remember I was driving up here and I was thinking, when we sold our company, we put together a book. It was a limited offering. I mean, it was a publicly traded company, so we had to be very careful on, we put a book together. I had a data room set up that essentially mirrored what that book was. Why? Because if anybody wanted to look for a question or clarification, they could go from section 1 to section 1 in that data room and pick up things, okay? So if somebody submits a request for you, respond in a form in which they repeat the question, right? If you just send me 1, 2, 3, 4, 5, 6, I don't even know what the question is sometimes. Definitely based on some of your answers, I don't know what the question was sometimes, because I'm not really sure what I'm exaggerating a little bit. Now, on a good front, what I would say, and I was very happy, generally speaking, the level of writing was better than what I've seen in a lot of other terms. I've been doing this case study since day one, and I've seen some horrible writing, and I would say that the actual structure of the sentences was a lot better. Now, I did get things like typical writing. A warranty. What's a warranty? A warranty is a warranty. A warranty is a guarantee. No, it isn't a guarantee. A guarantee is something. A warranty is something else. Like, don't use a word to define itself or specifically say something else. Okay? I specifically, and this is the problem with Google, right? I specifically asked in a lot of questions, in your own words, tell me what a warranty is. I would rather that you would have told me a warranty is a structure under which one is promising a certain condition or state and will stand and live by it, rather than somebody going and cutting and pasting something from Investopedia. Who used Investopedia here? Okay, you got a 0. You got a 0. No, listen, don't ever use Investopedia in my